Então 5 horas da tarde até 7 horas da noite até meia-noite. Pegue a máxima e a mínima dessa faixa específica. No entanto, estou voltando com um estrondo. Antes. E, claro, aqueles que estão no Discord, especificamente no canal Premium, sempre viram isso, não nesta imagem exata, mas na mesma formação exata. Explicarei o que é essa configuração e como você pode usá-la para formar ideias de negociação potenciais durante o dia. Então, isso é para todos os traders que fazem transações diárias. Aqueles que desejam fazer negociações dentro e fora do mercado no mesmo dia, variando de expansões de 1 hora a várias horas seguidas, provavelmente uma expansão de 4 horas. Tudo bem, então, sem perder tempo, vamos para esta videoaula. O que é isso que você vê na sua frente que é considerado a faixa asiática, certo? Esta é a máxima da faixa asiática e a mínima da faixa asiática. Estamos na Nasdaq. Então, isso são futuros. Vamos das 8 horas da noite, que são 8 horas da noite até meia-noite. Certo, então, para futuros, você vai das 8 horas da noite até meia-noite. E para forex, você usaria 7 horas da noite, então 5 horas da tarde até 7 horas da noite até meia-noite. Pegue a máxima e a mínima dessa faixa específica. Eu gosto de usar a ferramenta retângulo. Você pode usar o que quiser. Apenas certifique-se de ter o ponto médio desenhado, pois o ponto médio na maioria dos casos será seu TP1 e TP2. Claro que será a extremidade oposta da faixa, dependendo se você está otimista ou pessimista. Então, o que exatamente esse modelo envolve? Como você realmente negocia isso? Como estamos usando a faixa asiática para determinar nosso viés de sessão ou viés intradiário? Certo. Primeiramente, você vai querer localizar os níveis-chave vindos do período de tempo maior. No momento, estamos no período de 5 minutos. Seu objetivo é localizar os níveis-chave vindos de um período de 4 horas e diário. O ideal é que os níveis-chave de 4 horas e diários sempre funcionem melhor do que quaisquer níveis vindos de 1 hora. Portanto, o nível-chave de 4 horas e os níveis-chave diários são algo a que se deve prestar atenção e essa é a primeira coisa que você deve plotar em seus gráficos. Vamos anotar isso. Etapa número 1. Encontre o nível-chave. Etapa número 2. Localize a máxima e a mínima da faixa asiática. Espere até a abertura da meia-noite. Ok, então localize e desenhe a máxima da faixa asiática. Esta é a faixa de abertura asiática, não a faixa asiática completa. Portanto, a faixa de abertura asiática, máxima e mínima. Estenda a máxima e a mínima para a direita com linhas. Ou se você quiser apenas estender a ferramenta retângulo, sinta-se à vontade para fazê-lo. E a etapa número 3, a mais importante. Eu diria que o número 4 seria o mais importante, mas a etapa 3 apenas coloca tudo em perspectiva e dá dicas de como a configuração vai se formar. Ok, então a etapa 3 é procurar por uma sopa de tartaruga de uma máxima ou mínima da faixa da Ásia ao testar um nível-chave. Ok, então procure por uma sopa de tartaruga. TS significa sopa de tartaruga da faixa da Ásia ao testar um nível-chave. Tudo bem. O que é a etapa número 4? Então, antes de mais nada, quero deixar algo claro. Estou dando a vocês as etapas de antemão. Cada etapa está sendo revelada de antemão e eu vou me aprofundar em cada uma delas muito em breve. Ok? Então preste atenção, concentre-se, anote isso, pause o vídeo, retroceda e concentre-se. Ok? Etapa número 4, procure por deslocamento. E para aqueles que não estão familiarizados com o termo deslocamento, eu explicarei. No entanto, a regra é, número 4, procure por deslocamento da faixa da Ásia. Não importa se você está otimista ou pessimista. Claro, se estivermos acompanhando as máximas asiáticas, você procura por um deslocamento de baixa. Se estivermos acompanhando as mínimas asiáticas, você procura por um deslocamento de alta. E, claro, o passo número 5 é a entrada. Então, onde você entra? Na verdade, sabe de uma coisa? Falaremos sobre a entrada em breve. Certo? Então, essas são suas etapas para o modelo de intervalo asiático. Tudo bem. Agora, vamos localizar tudo isso junto dentro deste intervalo bem aqui. Então, primeiro, encontre o nível-chave. Temos uma lacuna de barriga justa de 4 horas bem aqui acima de nós. Se formos para o período de tempo mais alto, você notará que este é um nível-chave de 4 horas, lacuna de valor justo de 4 horas. Tudo bem, vamos voltar para os 5 minutos só para que vocês possam ver este nível-chave de 4 horas bem aqui na forma de um limite de valor justo. Tudo bem, então o nível-chave está marcado. O que é isso? Região sombreada em azul logo abaixo de nós. Este é um nível-chave diário na forma de uma lacuna de valor justo inversa diária. Vamos para o período diário e mostrar isso a vocês. Temos o gap de valor justo inverso diário que está sendo respeitado e mantido atualmente. Tudo bem, então essa é a região sombreada em azul, o gap de valor justo inverso diário. Basicamente, outro nível-chave que podemos usar para jogar na faixa asiática. Certo. Então, no período de 5 minutos, localizamos os níveis-chave, um vindo do período de 4 horas e o outro vindo do período diário, um acima das máximas asiáticas e um logo abaixo das mínimas asiáticas. Certo. Agora, passo número 2, localize e desenhe a máxima e a mínima da faixa de abertura asiática. Para futuros, mais uma vez, vou repetir que é das 8 horas da noite até meia-noite, claro, horário padrão de Nova York, UTC-5. E para forex, seria das 7 horas da noite até meia-noite, UTC-5. Certo, então das 8 horas da noite à meia-noite para futuros, das 7 horas da noite à meia-noite para forex. Desenhe a máxima e a mínima que estão marcadas com esta linha aqui e esta linha aqui. Certo. Etapa número 3. Procure uma sopa de tartaruga da faixa asiática enquanto testa um nível-chave. Testamos algum nível-chave acima ou abaixo da faixa asiática? Sim, testamos. Qual nível-chave testamos? O nível-chave de 4 horas na forma deste valor justo. Este é um PDA de baixa. O preço vai querer formar uma sopa de tartaruga em uma alta de curto prazo enquanto explora a matriz de PD de baixa e então cair rompendo a estrutura de mercado e assim por diante. Certo, então exploramos o nível-chave de 4 horas acima das máximas da faixa asiática, formando uma sopa de tartaruga em uma alta de período de tempo menor bem aqui. Para então cair. Agora parece que estamos formando uma sopa de tartaruga nas máximas da faixa asiática. O que você percebe mais especificamente aqui? Estamos formando uma sopa de tartaruga em uma alta horária. Esta é a alta das 4 da manhã especificamente. E a vela das 5 horas da manhã faz uma sopa de tartaruga na máxima da vela das 4 horas da manhã para então seguir para o lado negativo, tocando em um nível Q de 4 horas com um CRT de 1 hora acima das máximas asiáticas, quebrando a estrutura do mercado. Onde a estrutura do mercado quebra no período de 1 minuto bem aqui. Então, neste nível aqui, assim que fechamos abaixo, confirmamos uma mudança na estrutura do mercado para o lado negativo, pelo menos para a próxima sessão. Tudo bem. Então, até que seja dito o contrário, é claro, neste exemplo, nós quebramos a estrutura do mercado enquanto formávamos PDAS de baixa, fizemos uma sopa de tartaruga em uma máxima de curto prazo enquanto tocávamos no nível-chave do período de tempo mais alto acima da faixa asiática com a mudança na estrutura do mercado que você está antecipando e procurando a sopa de tartaruga da alta da faixa asiática enquanto toca nisso. Tudo bem, próximo passo número 4, o mais importante, como eu disse antes, é procurar o deslocamento da faixa asiática, seja a máxima ou a mínima. Qual período de tempo você precisa usar para procurar o deslocamento? Muito importante. Muito importante. Você deve usar os intervalos de tempo de 5 e 3 minutos para procurar o deslocamento da faixa asiática bem aqui. Então, se você não estiver entrando bem aqui e estiver entrando usando essas etapas bem aqui, você estaria procurando por uma lacuna de valor justo se formando ao cruzar para as máximas da faixa asiática. Então, o que é deslocamento? Deslocamento é a criação de uma faixa de preço desequilibrada ao cruzar para um nível específico, sendo esse nível específico as máximas asiáticas e esse desequilíbrio no preço sendo essa lacuna de valor justo. Portanto, a criação de uma lacuna de valor justo ao cruzar para um nível após uma mudança na estrutura do mercado é o deslocamento que você está procurando. Você está simplesmente procurando por uma lacuna de valor de 5 ou 3 minutos ao retornar para a faixa asiática. Nesse cenário, seria retornar para as máximas da faixa asiática. Nível-chave atingido por tartarugas nas máximas da faixa asiática. Mudança na estrutura do mercado, deslocamento para a faixa asiática. Temos a formação da lacuna de valor justo bem aqui. E a lacuna de valor justo foi respeitada. No entanto, superamos isso e respeitamos aquela outra lacuna de valor justo de 5 minutos logo acima de nós. Ambas foram boas entradas. Tudo bem, então, em ambos os cenários, você não teria sido parado. Onde estão seus alvos? TP1 sendo o ponto médio da faixa asiática bem aqui e TP2 sendo a extremidade oposta da faixa asiática. Como exatamente essa configuração se pareceria? Por exemplo, vamos usar essa lacuna de valor justo de 5 minutos como uma entrada. Colocaríamos nosso stop loss bem acima deste nível bem aqui. Teríamos o nível de taquerite na faixa asiática baixa. Isso seria um movimento de 129,25 pontos, talvez um pouco mais. Movimento de 129,75 pontos com um stop loss de 16,5 pontos, R de 7,86. Negociação no período de 5 minutos. Agora, se baixarmos isso até aqui, ainda é uma negociação válida em um RTR de 2,29 e ainda indo para mais de 100 pontos na negociação. Então, por que o stop loss está acima aqui? Porque este é um bloco de ordens de 5 minutos. A ideia é que, se virmos deslocamento, não queremos que os preços rompam o bloco de ordens. Ok, queremos que os preços respeitem os PDAS de baixa. Tudo bem, e isso conclui o vídeo. Na verdade, você sabe de uma coisa? Deixe-me falar sobre esse ponto aqui onde o preço decidiu mudar. Então, o TP completo foi atingido, a faixa asiática foi cumprida. E isso só mostra que isso não pode ser usado apenas uma vez durante o dia, pode ser usado muitas e muitas vezes hoje. Por exemplo, você poderia ter usado o modelo de faixa asiática 2 vezes. Na segunda vez, sopa de tartaruga nas mínimas da faixa asiática. Aproveitando o nível Q, vamos diminuir os períodos de tempo ou, desculpe, diminuir para 1 hora. Temos o CRT de 1 hora também. Isso foi falado em T, nosso prêmio. Vamos diminuir para um período de 15 minutos. Temos o período de tempo inferior, CRT de 15 minutos. Valide isso com o nível-chave e a mínima da faixa asiática. Agora você quer ver o deslocamento em um período de 3 minutos e 5 minutos. Deslocamento confirmado com esta primeira lacuna de valor justo aqui no período de 3 minutos. Nunca consegui explorar essa lacuna de valor justo e o preço continuou a se expandir rapidamente. Portanto, você não teria encontrado uma entrada enquanto procurava e esperava por esse deslocamento para a tendência de alta aqui. No entanto, se você cair para 1 minuto, houve de fato uma entrada de bloco de ordem de 1 minuto que se originou desse bloco de ordem bem aqui. Sua entrada foi a vela de 950 que atingiu o bloco de ordem. Tudo bem, então isso conclui a videoaula falando sobre o modelo de intervalo asiático. Eu recomendo fortemente que você dê uma olhada nisso. Alguns de vocês podem ter acabado de encontrar seu modelo. Alguns de vocês podem ter acabado de ter seu momento eureka. Alguns de vocês podem ter finalmente entendido como obter seu viés de sessão ou viés intradiário para negociar com sucesso. Espero ver todos vocês em breve no futuro dentro das paredes da TSR. Por enquanto, até a próxima, tomem cuidado.
How's it going, everyone? This video is going to be over daily bias and draw on liquidity. We'll go through the PDF and then a bunch of examples. And before we get into it, I'd like to give a big thank you to the MMXM trader for teaching me many of these concepts as well as his next day model. The easiest way to frame a draw on liquidity or have daily bias is using previous day high and low. So for example, up here, unless price is going to consolidate and not take out the low or the high of the previous day, we are going to have it either take previous day high, previous day low, or both of these. So the way I look at it is price more likely to take previous day high or previous day low. In this case, I would expect price to be reaching for previous day high, as we are trending upwards. So that would be my draw on liquidity. Similarly, over here, we are trending down. So I'd expect price to reach for previous day low. Previous day high and low can also be used as liquidity pools to frame a reversal. So for example, here we reach into this previous day high, we can't displace above it, and price reverses. Similarly, over here, we reach below this previous day low, can't displace, and we come back in the range. So for example here, just using previous day highs and lows, we have our previous day high. A reversal is framed off of previous day high. From here, since we close back in, I'm expecting price to reach for previous day low. As shown here, we reach for this previous day low. The next day, a reversal is framed off of this previous day low, as it cannot displace below. Now from here, I'd expect the next day to reach for this previous day high and continue to reach for previous day high until a draw on liquidity is met. So let's hop into the charts and look at a few examples of this. So in this example, we're just going to take a look at using previous day highs and lows to frame a bias or a draw on liquidity. So for example here, we have our previous day high and we closed above it. So I would like to see price move higher. An easy draw would be this previous day high. Letting price move forward, we close over it again. So another easy draw on liquidity would be this previous high. Right here, we take our previous high, but we can't close over it. We fall back in. So now I'd want to see if previous day low gets taken in my draw on liquidity, or my bias would be short. So now we reach and close below, and now I want to see, do we close or reach below previous day low? Right there, we reach below previous day low and close. So now I want to see, do we reach below previous day low again? Reach below previous day low and close. So I want to see if we take previous day low again. Right here, you can see we take previous day low, don't close outside the range. So now I would want to see a move higher or a reach for previous day high. Close outside the range, so bullish, or reach for this previous day high. Right there, we actually gap above it, come back in the range. So this would be bearish for me. So I'd want to see, do we reach for this previous day low? Right here we do, but we can't close outside this range. So now I'd want to see previous day high or be bullish. Right here, you can see we actually took the low and the high. And so what I look for here is we swept this low, couldn't close below it, and we actually take previous day high and close outside of it. So from here, I would be looking for previous day high. And then we get a very large candle up, expecting some sort of consolidation, but if we don't stay inside, I'd want to see previous day high. Right here, you can see we took previous day high. So now I'd want to look towards previous day low. Can't close below there. So where would I want to see? Previous day high or be bullish. And there we go. Close out. So then once again, can look for previous day high. Close over that. Can look for previous day high. And you guys get the point by now. Now, it won't be like this every day, but I hope you can see how just using previous day highs and lows, I can frame an easy draw on liquidity, bias, or an area for a reversal. So let's get back to the PDF and look at some other examples. Another thing I look for is the previous week's high and low. So for example, here we have a weekly range, and I will mark out the high and the low. And this can be used to frame a reversal, such as so, and then ideally looking for the other side of the weekly range, or it can also be used to frame a draw on liquidity. For example, here we return to a premium, reach an order block, and then the previous week's low is the draw on liquidity. So let's hop into the charts and look at a few examples. So in this example, we're going to go through the daily chart, looking at previous week's highs and lows and how price reacts around them. So right here, we have our previous week's low and previous week's high marked out and extended into the next week. So as we continue forward here, what happens? We don't reach for previous week's high or low, and we end up being range bound. So marking out this next week, it is a short week, so there's only 4 candles, but let's see how price reacts around those areas. You can see right here, we take previous week's low, so let's see what the next candle does. There is a fair value gap over here. And then we come back into the range. Where would I expect price to go from here? I would expect it to reach for previous week's high. And there we go, we hit previous week's high on a Friday. So here we have the next week marked out. Let's see if anything happens. So you can see right here, on Monday, we reach into previous week's high and close below. That makes me think I want to see the previous day low. You can see we reach over previous week's high again. We also take the low. So here I'm a little undecided, but we still are closing below previous week's low, which leads me to a downside bias. And there we go. We start to make a move down. So going into the next week and moving the lines over, you can see that Monday we swept previous week's low and formed a nice bullish reversal candle. This leads me to believe that we're heading for previous week's high. So letting this play out, we retest that previous week's low, and there we go, over previous week's high, and we get our expansion to the upside. You can see using previous week's high and low, I can not only frame a reversal, but can also use it as a draw on liquidity. In this next section, I'm going to be talking about swing points, failure to displace, as well as the next day model. If you don't know what swing points are, please check out my liquidity video. It will be linked in the top right corner. So using swing points, I can frame a drawn liquidity off of that. For example, here, price is trending up. Where is it likely to go? We have an old high resting over here. I can also use that to frame a reversal. So for example, here, using this liquidity pool resting above here as a point for a reversal. That leads me into the failure to displace or the lack of displacement over swing points. So for example here, if we have a swing low and price fails to displace under it, my bias can then be up. Similarly up here, when price fails to displace over a high, my bias can be down. This then leads me into the next day model. So with the next day model, using PD arrays or old highs or old lows, and when price fails to displace below a low, my next day, I can expect price to move higher. So right here, I would anticipate a open low high close candle or a bullish candle, and you can see how that would work out. And then similarly up here, when price takes this swing high, closes back in the range, I can anticipate an open high low close or a bearish candle. So looking at a set of price action using that, you can see we sweep this high right here, close back in the range. I can anticipate this next candle being open high low close. Similarly over here, we respect this PD array here. Next day, I would want to see open, high, low, close. This candle stays inside. I can use that bias and continue to use it until we reach our draw on liquidity, which in this case is sell side liquidity resting at the swing low below. So let's get into some charts and look at a few more examples. For this next example, we are just going to be walking through DXY on the daily chart and using what we have just learned and applying it. So if you notice right here, we do have a fair value gap resting below here, and price is drawing towards it. So let's see what happens. If you notice right here, what do we get? Let's just take a look at our previous day low. We cannot displace below previous day low, which leads me to believe that we should reach for previous day high. Marking out previous day high, let's see what happens. We reach up and we close out, so I'd want to see price reach, once again, higher. What happens here? We reach up, fill this fair value gap, but even more simple, we can't close outside our previous day's range, which leads me to believe that we should be reaching lower, or in this case, sell side liquidity resting right above a fair value gap. Right here, we reach lower. We have not reached our drawn liquidity, so I'd want another candle down. Here we get a candle down into our drawn liquidity or that fair value gap. And if you notice, we can't close outside the range, and we close back in. So I can see us reaching for our previous day high, or in this case, if we look at a swing point, we want to be reaching for this high. Here we get a closure outside that high. And so what should we expect? Price to move higher or consolidate with a large range. From here, close back in the range, would want another day down. So would want to see below this previous day low. And if you've already seen this example, this order block resting right here. Here's where the next day model could be applied as we are respecting a PD array. So reaching into this PD array, closing outside. Next day model would say, look for an open low high close or a bullish candle. Where would that bullish candle want to be reaching for? Well, we could look for previous day high, or we could look for swing points in the market. So looking at our next day, we get a reach. We have not hit our drawn liquidity, so we would want to see the next day do what? Reach for that drawn liquidity. We get a closure outside of that, so I'd want to see price reach for another daily high. Here you can see price takes this high, closes back in, so I'd want to see price reach for this previous day low. We are in an uptrend here, so I wouldn't want to see it shift too much, or we are likely to go lower. Here you can see we may have swept that, can't tell on this time frame, but from here, I don't really have a lot of bias. So what I can do is mark out our high and our low and see which one gets taken. So inside bar, just having an uptrend, I think it's more likely to reach for this high. Here we get a closure outside that high. Now what can we use? We can use this swing point in the market. Here you can see we reach above this swing high, can't close outside of it, and close back in. From here, we can look for previous day low or a swing point in the market, which we already have marked out. Here we get displacement down, very aggressive. So we already took this low, so we can look for either previous day low or a swing point in the market. We haven't yet reached this low, still closing out, so either previous day low or this swing point. Still closing outside, this is when I would need to look left. What do we have? We have a bunch of lows resting under here, or swing points. We can also mark out our previous day low. And then we get a large move through that. But you can see how you can use just swing points, previous day highs and lows, and displacement and closures over or below structure to frame a narrative, not every day, but a lot of the days of the week. So let's go through a few examples of going through bias all the way down to an entry time frame. This first example is going to be a London session trade, and then for our next examples, we'll do some New York session trades. So for example here, we're either consolidating in this little range here, so we could use this range high and low, or we can just use previous day high and low. So let's see what happens. No real bias going into this next day. So you can see we fail to close over this previous day high here. So what can I expect? We're already in a bearish trend. I'd want to see price reach where? Lower. So I can either look for previous day low, or I can look for a swing point in the market right here. So let's drop down to the hourly time frame and see what happens. So here we are on the hourly time frame. I'm going to go ahead and mark out midnight opening price, and let's see what happens. So right here, we notice what happens is we get a stop hunt, right, into a fair value gap. So I can go down and look to a lower time frame. If you notice the time this is occurring is London. So I would want to see a high of the day put in London. Here you can see this sweep on the hourly and the aggressive displacement off. So I can either look for an entry here or see what happens after this price action. Because this isn't a very big sweep, so I'd be a little concerned that it wanted to go up again. So looking at this fair value gap here, let's see what happens. There we get an aggressive move down off of that, and we have a fair value gap right here. So the way I can frame a trade here is look to enter the fair value gap, my stop on that high, and then I can either look for a fix to R or looking towards that previous day low we talked about. Furthermore, we could also go down to that swing point. So we'll just leave it right here and extend it if it gets there. So we let this play out. We get an aggressive move down towards our previous day low. Now, let's see what happens if we reach for that swing point. And there we go. Price reaches for that swing point and ends up continuing a lot lower. For this next example, you can see right here, we have a previous day low, gets swept, closed back over. Where would we be looking? Either this high or previous day high. So marking out this swing point here, see what the next day does. Next day sweeps this high, comes back into the range. From here, we can either look for 2R, or we can zoom back out and find a target there. So going back up to the hourly, let's see what we have. We have some nice lows resting over here. One of those lows right around 2R, or we can look for these lows down here. Going back to the 5-minute chart, if we're going to go reach for that lower one, so we're over 2R there, 2.55R. Let's see how it works out. So get a move up, some consolidation, and there we go, we hit RTP. So that is an example of a New York session trade and a London session trade using the next day model. Thank you to MMXM Trader for showing us that. If you haven't seen my video on that, I'll also link that in the top right. I hope this video was helpful and showed you how I find my daily bias. If you did find it helpful, please hit that like button, the subscribe button, and leave a comment below. If you have a great rest of your day, and I'll see you guys later. How's it going, everyone? I've received a lot of requests for a model and more top-down analysis. So for this video, we are going to go over the MMXM Trader's Twitter model. We will first look at what the model is, and then jump into a few examples using top-down analysis. MMXM drops a lot of information on his Twitter posts. Lots of great examples, and if you scroll through his feed, you'll stumble upon this post right here. So let's take a look at it. So this is the model we are going to be going over in today's YouTube video. This model includes skipping Mondays, focusing on the New York session only, executing on the 15-minute chart, using the economic calendar as your roadmap, and trading the day after your anticipated higher time frame level is hit. So let's go into this example here. So looking at the daily chart, we have this daily fair value gap as our draw on liquidity as noted here, and then we have a daily fair value gap above. This is Monday right here, so skipping this, we look at Tuesday, it reaches up towards our higher time frame level. Now, after we get a nice reaction off of this daily level, I'm looking for Wednesday to continue lower, taking the sell side liquidity and reaching for the draw on liquidity. Going into the hourly chart, you can see Tuesday, this is where we hit the daily fair value gap before getting an aggressive move lower. We have an hourly breaker. As we reach into Wednesday, price retraces back up into this hourly breaker, hourly fair value gap here, and moves away. Looking at the 15-minute chart, we have midnight open, and that was the move into the hourly fair value gap and hourly breaker, and the move away. As we head into the New York session, we have a 15-minute fair value gap here. Price reaches up into the consequent encroachment of this before delivering to the weekly open and eventually to the draw on liquidity below. So this is an example of the model, and I want to reiterate, skipping Monday, looking for when price reaches into that higher time frame level, looking the next day for the New York session 15-minute setup to deliver price. In this next example, we have a daily order block here, and here is Monday, Tuesday, Wednesday, Thursday. Thursday comes up, tests the daily level. With this closure, it's respecting it. So going into Friday, expecting to find short setups during the New York session. Going to the hourly chart, the important thing to note is the SMT at the highs here, and this hourly fair value gap, as well as the sell stops resting below, which would be the draw on liquidity. With the news, getting this wick up, however, the bodies are respecting this fair value gap, displacement down, bearish order block, and then that is the entry there, going towards the sell stops below. Next, we are going to look at NASDAQ on the daily chart. So if you notice right here, we just put in equal highs. So that would be a target for the future. We have bullish structure. And so I'm expecting this week to be bullish. However, this is Friday. We're going to skip Monday. Now in a bullish week, I'd want to see an open, low, high close. And if you don't know what I'm talking about, click this link right here. With that idea in mind, what do we have right here? We have some nice lows stacked right there, as well as a candle with no wick, which I like to target. We look at Monday. What did it do? Let's zoom in here a little. Monday took previous day's high, or Friday's high, closed back into the range. A next day move towards my draw on liquidity down here. So let's drop down to the hourly and 15-minute chart and see if there's something offered during New York AM session. So now that we are on the hourly chart, we can see we have our Friday's high right here. That was taken out on Monday before aggressive displacement lower. And here is our draw on liquidity mentioned on the daily chart. Let's see what happens. We ran these stops right here, could not close above and get aggressive displacement lower. So letting this continue. We get a move up into this fair value gap and then back down. So let's go to the 15-minute chart before New York AM session and see what appears. So here's our hourly fair value gap. And if you notice with this candle close, we have a 15-minute fair value gap right here. So ideally, I'd like to see during open price reach up into here and then make a move towards our drawn liquidity down here. And there you go. You can see our drawn liquidity was hit. And that is the move for the New York AM session. Going back out to the daily chart to see how this played out, you can see Monday took previous day high. We got a move towards this low. But what did we do once we hit our drawn liquidity down here? We came back in and closed back into the range. So now what can we expect for Wednesday, Thursday, or until we reach this high? We can expect expansion up. And even a little more expansion than expected. For this next example, we are looking at Euro USD, and you can see we have sell side liquidity right here in the form of equal lows. Looking in here, we can mark out previous week's high because that is our Wednesday. So Monday, Tuesday, Wednesday, Thursday, Friday. That's previous week. That's the high. Looking into Monday, letting that form. Similar to our latest NQ example, we took buy side liquidity and closed back into the range. So with this, we can expect next day to reach for lows. And you can see we have some lows right in here as well as down here, but mainly focused on New York AM session. So dropping down to the 1 hour chart. So here we are on the hourly chart on Tuesday, going to mark out the midnight open and let this play out and see if we get a setup for New York AM session. And here we are getting close to New York AM session. So I'm going to drop down to the 15-minute chart. You can see we had a fair value gap right here and a fair value gap right here, supporting bearish order flow. And we have another fair value gap right here. So ideally, get a reach into here before going lower. However, that does not occur. So with it exiting and getting this large move, later New York session mostly consolidates. So we will go to the next day. Tuesday, we do get a move down, but no setup for New York session. So I'm going to look for Wednesday to have a continuation lower. Going back to the 1 hour chart. So now on the hourly chart, let's look to see what happens. Currently, we have a large displacement candle down. And now we have a fair value gap, so we will go ahead and mark that out. And you can see how we retch above midnight open, but we're currently respecting this fair value gap right here. Right, so as we near the New York AM session, let's hop down to the 15-minute chart. So if you look right here, when we went above midnight open, we displaced down, and we have a fair value gap right here, price respects. So from here, I would like to see a move towards this low. That is our current sell side liquidity before reaching for our old daily lows that we have marked out. Letting this play out, we get a move below that low, come back up into the fair value gap and continue lower. So we'll go back out to the hourly chart. You can see where we want to see these lows right here, and ideally those equal lows on the daily chart down here. Going back to the daily chart, we get a continuation and do end up taking those lows. For our next example, we are still on Euro USD, and I'm looking at this order block right here, letting Monday play out as this is Friday. You can see we stay inside bar and do not reach our higher time frame PD array. Tuesday, we do end up reaching into that PD array and getting a reaction off of it. So the next day, I'd want to look for a continuation lower, ideally for these lows, but we have yet to hit previous week's low as well. So here we are on the hourly chart, and we have our daily open marked out. We have sell side liquidity resting below, and then we have our daily sell side liquidity down there. So letting this play out, let's see what we get. And we get a pretty immediate drop off here. However, as we near the New York session, we come back into this range. So now we have engineered more sell side liquidity. Let's drop down to the 15-minute chart. So right here, we can see we have a 15-minute fair value gap right here, an old high in it. So that is a possible entry there. However, if we miss this one, we can still look for other entries. Right here, let's see if we get a fair value gap. We don't. However, we do have this old busy here. It should be used as the resistance. So I'd like to see price resist off of here before reaching for this sell side and sell side below. And there we go. We reach for sell side, retest previous lows, engineer more liquidity, sweep highs, then go. You can see how after we hit this order block, we take our initial sell side liquidity and displace all the way through these old lows. For our final example, we are going to take a look at GBP USD. So if you notice, make a smart money reversal right here. Order flow is bullish, and we have some highs resting over here. So marking out those highs as so. Let's zoom into the daily over here. So with this being Friday, and if I'm expecting a bullish week, I'd want to see an open low put in before expansion higher up into these highs, and as well as Friday's high before we put in a high and close. So letting Monday open up. Tuesday, drop down, but what do? We respect the mean threshold of this order block here. So if we're going to get expansion in a classic Tuesday low a week, I'd want to see Wednesday expand towards Friday's high and into these old highs. So with that idea in mind, let's go down to the 1 hour chart. Here is our midnight open, and as we make our way towards New York AM session, what do we have? Well, we have an order block or down close candle right at midnight, and then a fair value gap right here. So as we play this towards New York open, here on the 15-minute chart, you can see we also have a 15-minute fair value gap right here, which I will mark out in a box so we can differentiate the two. And let's see what happens here if we get a reaction. And so a pretty aggressive reaction so far, retesting midnight. And if you notice how no bodies close below midnight here. Now what do we get? An aggressive move out. That candle closes. We now have a fair value gap right here. Displacement out. And where do we want to see this expand towards? Friday's high as well as those highs. So let's see what kind of expansion we get. And there we go. We take Friday's high, stay in the range, and then we'll hop out to the daily to see how this week ended up. We made a move higher, engineered more liquidity at the highs for then Friday to reach higher. I hope you guys enjoyed this video. Thanks to MMXM for posting this model on Twitter, and I hope this cleared it up for some of you guys. If you did enjoy it, please consider liking and subscribing, and I hope you enjoy the rest of your day. See ya. How's it going, everyone? This video is going to be over the easiest draw on liquidity, and it is generally present almost every day in the market. Now, before we begin, I'd like to give a shout out to the MMXM trader for his teachings, so let's get into it. Now, unless price is going to remain in a consolidation, as shown here, where it fails to take out either side of the range, it is going to reach for previous day high or previous day low, or both of these. So knowing this, if I stay out of consolidations, if price is trending up, I can anticipate previous day high being taken, and if price is trending down, I can anticipate previous day low being taken. So let's hop into the charts and look at a few examples of this. So the easiest way to define a trend is in a bullish trend, price will continue to take previous day's high over and over again, and in a bearish trend, price will take previous day's low over and over again. So here we can see we have PD arrays supporting price higher, so I'd anticipate price to keep reaching for previous day's high. So if we go ahead and mark this out, go ahead a day, you can see previous day high has been reached. Continue this. Previous day high has been reached again. Previous day high has been reached again. And you can see how it continues over and over again. And that is how you know we are trending upwards. So let's take a look at when price is trending down. So here you can see price has been trending down. And if we anticipate this to continue, we'd like to see previous day lows being ran out. So as we continue ahead here, you can see we took out our previous day low, as well as these lows here. Here we do not take out this previous day low. What do we have? We have a fair value gap here. So we could reach into here before moving lower. So here we get a retracement. Now we get a down close candle respecting the consequent encroachment of this fair value gap. So now mark out our previous day low. We reach for our previous day low. And if we expect this to continue, we'd want to see price continue to take previous day lows. Now, it's not always going to be so clean of a trend down. For example, if we get retracements or liquidity sweeps here, we're going to have a series of up-close candles creating order blocks. So now that you understand that when price is trending up, we are likely to see previous day's highs being taken, and when price is trending down, we are likely to see previous day's lows being taken. Let's hop back into the PDF and explain how to use this. When I get into the daily chart, the first question I ask myself is price more likely to reach previous day's high or previous day's low? If I can answer this question, I then have a draw on liquidity and a target, and I can look to frame an entry on a lower time frame. So for example here, if price is going to be reaching for previous day's low, I can drop down to a lower time frame and look to find a point of interest to frame a trade towards that previous day's low. Now, besides looking at the overall trend to determine if I want price to reach for previous day's high or low, there are a few other ways that I can do this. Now, I cover this in depth in my daily bias video, but we will go over it quickly so you guys know what I'm talking about. What I focus on is displacement or a lack of displacement over or below previous day's high and low. So for example here, when we fail to displace over previous day's high, that gives me a downwards bias looking for previous day's low. Similarly, when we fail to displace below previous day low, it gives me a bias to reach back into the range. So a quick little example here, we have previous day high, we fail to displace over it, a reversal is framed there, and then the next day, we can anticipate previous day low being the draw on liquidity. And then since this candle displays below these lows, I'm anticipating a continuation of the trend. So for the next day to be reaching for this previous day low. Now here a reversal is framed. We can't displace below this low. So then I want to see previous day high. Now on this day, we close over the previous day and I want to see previous day high once again, as shown here. Now I cover this more in depth in my daily bias video, like I said, but I just wanted to show you how I use the daily chart to frame a draw on liquidity. The last thing I'm going to touch on is how many days I will look back for previous day's high and low. And for me, that is 3 days that I will look back into price action. So for example here, if I'm on the current day, I will look back 3 days and mark out the previous day's high and low. Similarly over here, current day, last 3 days mark out the high and low. And marking these out and extending them can also add some confluences. For example here, when we deviate below this previous day low, come back into the range, we retest this previous day low before continuing higher. And if you've watched my box setup video, you know what that looks like. So let's hop into some examples. So here we are on NASDAQ's daily chart, and we are going to go through some examples. We will first go through the daily chart and find our bias for each day before dropping down to a few lower time frame examples. Now in these examples, I'm going to focus on just using the previous day high or low as my target. However, when I'm actually watching price, I will look for extensions beyond and below previous day high and low. So here we have a very aggressive displacement higher. So I'd be looking for previous day high to be taken. Here we take previous day high, close over, and I'd want to see previous day high be taken once again. Here we take previous day high, displace over this fair value gap and over previous day high. So I'd want to see that taken once again. Here we close over, so I'd want to see previous day high being taken once again. Here we take previous day high and low, we close bearish, and we also reach into this daily fair value gap. So with this in mind, I'd want to see price reach for this previous day low. Here we get aggressive displacement below previous day low, So I'd want to see price reach for this previous day low. So here we get an up close candle, but my idea hasn't changed. Because we reach into this daily fair value gap and displace lower, I'm wanting to see lower prices and reach for these equal lows. So with that idea in mind, I'd want to see previous day low and this prior low as well. So here we do reach for this previous day low and the prior day low as well, and we close back into the range. Now, if you've watched my daily bias video, this is where you might get confused and be looking long. However, with the structure being bearish, I ideally want to see price close below this up close candle. And what would that do? It would validate it as an order block. So let's see what the next day does, but ideally reach lower and close below here. So here you can see we reach lower. Now we don't close below previous day low, but we do aggressively move lower and close below this up close candle, validating it as an order block. So with that idea in mind, I'd want to see price reach lower once again. Here you can see we retest that up close candle, reach lower, so I'd want to see previous day low again. Once again, displacing lower, would want to see previous day low. And there we go. This places below this low, closes back inside. So ideally, I'd want to see price reach up to this previous day high, or get some sort of consolidation after running these lows. So even though that I had a bias for almost every day here, it does not mean that I will find an entry each and every day. So let's go back to this Monday here and see how it would play out, and then look into the next couple days. So here I have marked out our new week opening gap and the consequent encroachment of that, as well as our previous day high, which we noted in the last part as our drawn liquidity for this day. So let's see what happens as we come into the New York Open. So as we come into the New York Open here, you can see we consolidated through Asia and London, and then we manipulated down here. So seeing this as accumulation, manipulation, I'd want to see distribution higher into this previous day high. So let's go down to a lower time frame and see if we can find an entry. So if you've seen my box setup video, you know that price could reach back into this deviation here before moving higher. But what do I see here? I see a 5-minute fair value gap. So looking to enter on the fair value gap, I stop in the low, and then targeting this high, I have a risk to reward of just about 2R. So letting this play out. And there we go. You can see price reached a little bit lower. It reached into this deviation of this range before reaching higher. It rejected off of this new week opening gap, consequent encroachment, before expanding into our previous day high. So there's an example of going top down. So let's go to the next day and see if we can find anything else. So taking a look at the next day, we will mark out our previous day high and then go down to the lower time frames. So here we are in the lower time frames with our previous day high marked out. So let's see what happens as we move forward in time. So you can see the Asia session already took out previous day high. So just using previous day high or low to frame a target and a drawn liquidity, with that already being taken in the Asia session, I'm not interested into the New York session. Let's let it play out and see what happens. And you can see we get a continuation of order flow up into the New York AM session. Let's go to the next day. So here we are on the next day. I've marked out our previous day high, which I'll be using to frame a drawn liquidity. So let's see what happens as we move into London session. So you can see here, London doesn't really do a whole lot, kind of consolidates, takes this high, moves lower, takes its initial low. So let's see what happens here as we move towards the New York AM session. So here we move a little bit higher. And that is 8:30 news, which manipulates down. So now if we're going back to our first example, accumulation, we manipulate down. Where would we want to see distribution? Opposite of our manipulation into previous day high. So it looks something like this. So let's go take a look at the lower timeframes and see if we can find anything. So here we are in the lower timeframes, and it's a little bit easier to see that accumulation, news manipulation, and then now anticipating distribution into previous day high. So let's take a look and see if we can gain an entry to this. Ideally, I'd want to see a close below this 8:30 opening price and this series of down close candles here. So let's see what happens. And there we get a close below this. So just in terms of risk to reward and using the box setup, I'd want to see a retest of this manipulation before reaching higher into this distribution and previous day high. So let's see what happens. And there we go. We reach and hit our previous day high, completing our AMD. So let's go take a look at the next day. So here we are on the next day, and I want to see price reach for this previous day high. So let's drop down to the lower timeframes and see what happens. So here we are on the lower timeframes, and we have our previous day high marked out. So let's see what happens. Here you can see at the start of the Asia session, we already took that previous day high. So just watching for previous day high and low as targets, I'm not going to be watching the following sessions. However, let's see how it plays out. And you can see overall it was a pretty choppy session prior to reaching into this daily fair value gap here. I hope you found this video helpful and insightful in regards to draw on liquidity and daily bias, and that it showed you that even with daily bias or a clear draw on liquidity, it's not always possible to get an entry. Now, if you did enjoy this video, please consider liking and subscribing, and I'll see you guys next time. How's it going, everyone? This video is going to be over discount and premium. However, for this video, you have to have a good understanding of buy side and sell side liquidity. So if you haven't already watched my video on that, it will be linked in the top right corner. So the first thing to understand in marking out discount and premium is finding the range. And so for that, I look for a swing high to a swing low, or essentially the most prominent range in this area. And from there, I will take, in this case, the gone box or a fib, and mark out from the high to the low. Doing this, we can see where our equilibrium rests right here with the 0.5 fib. So this would be the equilibrium of the range. Anything above the 0.5 fib is considered at a premium, and anything below the 0.5 fib is considered at a discount. So extending this box over to the left, we can get a better visualization of where our premium and discount of the range lies. It is important to note that there is not just one range within price action. There are multiple ranges within ranges. For example, here we have this range from this move down. However, when we put in a swing low here and move back up, we create another range from this high to this low. There are multiple different ranges within a set of price action, and it can get kind of confusing, so we'll jump into some examples to explain that. However, I first want to discuss why we use discount and premium. The main reason to be using discount and premium is because it shows where risk to reward is more favorable. For example, if I was to enter a long position right at the equilibrium of the range and put my stop on the low and put my target on the high, my risk to reward would be 1. However, the further into discount I get, the higher or more favorable my risk to reward becomes. The same goes for entering a short position. If I was to enter a short position at the equilibrium and put my stop on the high and my target on the low, I would have a risk to reward of 1. However, as I get deeper into premium, my risk to reward becomes greater. With that being said, if I'm looking for a short position, I'm looking for PD arrays in a premium to get short. If I'm looking for a long position, I'm looking for PD arrays at a discount to get long. For this first example, we are going to look at NASDAQ on the daily chart, and the first thing we want to do is identify a range. Well, we have a swing low right here, price leg up. So I'd want to mark out this high to this low. Now, one thing with ranges is they are expanding. So if price moves higher, we're going to track that with our equilibrium range. So as this moves higher, we're going to move it higher with it. We will continue to do that until a high is put in. Now, if this is the high, let's see. Okay, so we put in a swing high there. Now, if we're going to be looking for long positions, what do we want to look for? We want to look for a discount PD array. Do we have one? Yes, we have a fair value gap right here. So if I'm looking for longs, I want to be looking for longs in here. Let's see what happens. You can see we reach into that discount PD array and then move higher from there. For this next example, we are going to look at the dollar index or DXY and the interactions between equilibrium ranges. So if you notice here, we have a move up here. And so if we mark that out from our high to the low that made the new range, we have our equilibrium range. So with that, let's drop down to the daily. Now from here, if we are looking for long positions or a draw on liquidity for short positions, what would we want to look for? We would want to look for PD arrays in a discount. So looking into our discount here, what do we have? Well, we have a fair value gap here. So letting this play out, let's see where price heads for. And there we go, we reach our discount PD array. But now we look, do we have a new range? Yes, we made a range when we went from this high down to this low. So marking this one out. So from here, we would want to see price reach into a premium of the previous range. So letting a day play out. Now we have a reversal model. So if you look right here, we swept this lower time frame low, we broke structure up, and then if we mark out this displacement range, or this high to this low, we are left with a range that shows premium and discount. So just like before, if we are looking for long positions, I want to look where? I want a PD array in a discount. Well, if I look left, what do I have? I have an order block. So letting this continue, price reaches into here, into a discount, and respects the opening price of that order block. Now we expand higher. Well, what do we have now that we made a new range? Well, we can go from our high to our low. Now we have another range. So if price was to come back down, I'd want to see it reach into a discount. And fast forwarding to the new day, we put in a new high. So I track my premium to that high. And where do we go? Into a discount. For this next example, we have the pound dollar on the daily chart. If you notice, we filled this daily fair value gap, and then we make a new high, and we have an aggressive displacement range right here. So marking this out from high to low. If price wants to draw back into a discount, do we have a PD array in discount for it to reach for? We do. We have a small little fair value gap right here. Going to the next day, we get a sweep of Monday and Friday's high right here, a close back in. Next day model wants us to drop down, get a reach for that fair value gap. So now if I'm going to be looking for longs in a discount, I want to see some sort of raid on previous day low or some sort of setup. Right here, we raid previous day low, close back in, and what do we have above us? A fair value gap. So on the next day, I would want to see price reach back up. So for that, we'll go down to the 15-minute chart and look at some price action. So if we look right here, we start our new day, have midnight marked out, our Asia range high and low, and we sweep this Asia low and all these lows over here, filling this fair value gap. Then we get an aggressive move higher. And so what does that create? It creates another discount and premium range. For this one, I will also mark out an OTE. So from here, if I was looking for a setup, I'd be looking for an OTE entry and then a target of that daily fair value gap. And if you notice, by entering at a OTE, my risk to reward is 3.43 there versus 1.6 at an equilibrium. Letting this play out and continuing ahead, we reach into our OTE, and it's important to notice how there are no candle closes below there, right? It's respecting it. Get a move higher. And then there we go. We reach up into that daily fair value gap, and we end up going quite a bit higher than that. But that is how I would frame a setup. I hope this video helped out with your understanding of discount and premium, and if it did, please hit that like and subscribe button, and I'll see you next time. How's it going, everyone? This video is going to be over OTE, or optimal trade entry. Now, it is important to have an understanding of discount and premium prior to this video, so if you haven't seen my discount and premium video, I'll link that in the top right. The first thing we are going to do is go over a PDF, which will be linked in the description below. This will have fib settings, along with a few examples, and then we'll hop back into the charts and find a few examples. The first thing we are going to go over are the Fibonacci settings. So for these settings, I am going to be using the 0, 0.5, 0.62, 0.705, 0.79, and the 1. That is what I will input into the Fibonacci retracement tool. So it will look something like this example here, where we have a 1 and a 0 here with the discount and premium, or the 0.5, and then we have our OTE, or optimal trade entry zone, with our 0.62, 0.79, and the midpoint, which is the 0.705. So in TradingView, when I pull up the settings, it will look something like this. So now that I understand what the fib settings are, how do I use the Fibonacci retracement? What I will do is look for a swing high to a swing low. If you don't know what a swing high or swing low is, please check out my liquidity video where I go over that. But what I do is after I found my swing high and swing low, I drag my Fibonacci retracement from the swing high to the swing low. And from there, my retracement levels will be put onto the chart. Let's actually hop onto TradingView and go over an example of this. So in this first example, we'll be looking at a bearish scenario where we will draw it from high to low, and then we'll go into a bullish example. So if you notice, we have a swing high put in here. So let's see when we have a swing low. Okay, so here we have a swing high and a swing low. So using the Fibonacci tool, I can drag it from this high down to this low. On this bullish example, we have a swing low put in here. So now I am waiting for a swing high. So I can continue to drag this up as we form our range, like so, until a swing high is put in. Now we put in this swing high, and that is what it would look like to draw it out. So how do I use this? When price makes a swing high and swing low, and I mark out this range, I'm looking for price to retrace to an optimal trade entry. What is that? That's this zone from the 0.62 to the 0.79, including the midpoint of 0.705. From here, I'm looking for an entry or a lower time frame entry model to go lower or to reach for sell side liquidity resting below. So let's go back to our examples and see how they worked out. So back here with our bearish example, we have our optimal trade entry zone. So that is from our 0.62 to 0.79. And this is ideally where I want to be looking for either a short entry or a lower time frame entry model. But let's see what happens when price reaches back up into this area. Price reaches back up, hits the 0.705 or the midpoint of the OTE, and then reaches for sell side liquidity resting below. So let's go take a look at that bullish example. So back here with the bullish example, what can we expect to happen? Well, ideally I want to see a move out of this OTE area. And what do we have resting above here? A fair value gap. So I'd like to see price reach up into this area. And there we go, price reaches up into this fair value gap and we get a move out of the OTE. The next thing I want to talk about is aligning these optimal trade entries with other PD arrays. So for example here, when I draw out my fib and I see that this is my area where I am ideally looking for shorts, I look to my left and see if there's any PD arrays that line up. And what do I notice? I have a fair value gap right here. So now I have overlapping confluences. I have a fair value gap and an optimal trade entry. So let's hop back into the charts and see if we can find any PD arrays that align with our examples. So back to taking a look at this first example, I have drawn out the OTE zone and I look to my left and see what we have. Well, it's pretty clear we have a fair value gap resting in this area, but my eyes get drawn to these up close candles here. So now I have multiple confluences for this point of interest here to move lower. Now back to taking a look at this bullish example, I've drawn out the 0.62 to 0.79 with these lines here. Are there any PD arrays that catch your eye? Now, if you've seen my latest video, you'll notice we have a large down close candle sweeping these lows before we displace and close over this candle here. That validates it as an order block. But what do we notice about this order block's opening price? It's not in an OTE. This is when I would use the mean threshold of this order block or 50% of the body. Now I have another confluence here. Now there are many ways to do this, as I'm sure many people spotted this volume imbalance here, which was also respected. For me, I focus on which PD arrays catch my eye, and that would be this large down close candle and the mean threshold of it. The last thing I want to talk about is when I get this move out of an OTE and form a swing low, we now have another range. I can mark out that range and then use an OTE again. We'll hop into the charts because this does make sense when we use a lower time frame. So in this example, I'm going to be looking at Euro USD on the daily chart and then dropping down to the hourly chart. So if you notice, we have this displacement range right here. So ideally, I'd want to see price reach back up into an OTE here before moving lower. And here you can see price moves back up into an OTE here. So now let's drop down to a lower time frame to see the range that this move creates. So here we are on the hourly chart, and this is the displacement range that we marked out on the daily. And you can see we retrace back up into an OTE, actually filling this hourly fair value gap. So let's see if we get any displacement lower where we can mark out another OTE. So here we're starting to get this displacement down. So I'm using this high here that made the new low, and I'll continue to track it lower. Here we make a new low, so I'll extend this OTE down. Here we reach back up into an OTE and then displace lower. And we'll see how that move ends up. It takes this low and then displaces back up. So now we're going to continue this. I'd want to see price reach back down into this OTE. What do we have right here? A breaker. So let's see what happens when price returns to this area, if it does. So we get a nice reaction out of this breaker and OTE there. So now for a top-down example about how I would use this is here we have gold on the hourly chart and we get displacement down. I'm going to be watching this displacement range for an OTE. We make a new low, so I adjust my fib, and then I look for a PD arrays in this area. What do I notice here? I have a fair value gap in an OTE here. So now what I look for is I drop down a time frame. So now down on the 5 minute, let's see if price reaches back up into that OTE. Important thing to notice here is how price creates all these equal lows or generates liquidity. Now we reach up into this area. However, it's out of kill zone, so I am not watching this. We now enter my kill zone. We reach up, hit the 0.79. Body is still respecting the hourly fair value gap. And then we get displacement lower. So now we have a 5 minute fair value gap here, which I could be looking to enter. Down here on the 1 minute chart, I see a nice full bodied 1 minute candle reaching up into this 5 minute fair value gap and then getting displacement lower. This is an order block. And so what I would look to do is search for an entry here, my stop on this high, and then looking to target these lows that were generated prior to the session, or London session lows. So it would look something like this. And there we go, a 3R trade. In this last example, I'm going to be looking at ES. Here we have the daily chart, and you can see that Tuesday puts in a high a week, and we get expansion Wednesday and Thursday, and our weekly objective is this daily swing low, and we take that out. So I'm anticipating a TGIF setup to cap the weekly range. So with that idea in mind, let's drop down to the 5-minute. So down here on the 5-minute, I'm going to go ahead and mark out our daily open, and I'm anticipating this to be a New York reversal to go higher. What do I notice right here? A bunch of failure swings. So ideally I want to see price form a reversal in here and then reach for these failure swings up here and the daily open. So let's zoom into this price action here. So here we get a nice move down, a sweep, and then displacement higher. So the first thing I'm going to do is mark out this projection here from this high to this low and project it up. What do we notice about the 2 to 2.5 area here? It's resting just above these failure swings. So that lines up and gives me conviction that I'd like to see price reach for this area here. Dropping back down into this area, I want to see price close over these highs here. We get a nice close over here. So then what I'm going to do next is mark out from this low to the current high and mark out my OTE. So from here, I will track this high until we get a retracement. Put in new highs, track that. Put in a new high. And then we make this swing high here. So now I can put in my risk to reward tool, and ideally I want to be entering at the 0.705, but if I really want to be in a position, I'll look to enter at the 0.62. So then I'll enter here, and my target will be these highs up here. So a 3.4R trade. Let's see what happens. So we get an entry. It does eventually sweep here, go into the midpoint of the OTE. And then we get our displacement up. You can see there's a fair value gap entry there as well. And then we continue higher, hit this daily open, and let's see what happens. And it takes a while, but we do end up going and sweeping those failure swings at the high. You can see how daily open did provide some resistance there. I hope you enjoyed this video. If you did, please hit that like and subscribe button, and I'll see you guys in the next one. How's it going, everyone? This video is going to be over market structure shifts. Market structure shifts are important because it shows us where the structure is shifting from bullish to bearish or bearish to bullish. The first thing we are going to cover is displacement and how understanding that will help us identify market structure shifts. So what is displacement? Displacement is an aggressive move with full-bodied candles. This can be a singular candle or also multiple candles, and the easiest way to spot it is just looking for fair value gaps. So in this set of price action right here, you can notice we get an aggressive move lower here, breaking this low, closing below, and what do we form? A fair value gap. Similarly over here, we get an aggressive move, breaking this high, closing above, with large full-bodied candles. Now on a higher time frame, these would result in a single candle. So let's take a look at some examples of displacement. So if you notice here, we have a very aggressive move up and an aggressive move down. Well, if we're following the displacement, aggressive down comes after, so we're looking lower. What do we have here? An aggressive move down until this is invalidated, looking lower. Now we have another aggressive displacement candle or full-bodied candle creating a fair value gap, lower. Now we have another one here. So what do we notice right here? Well, now we get an aggressive move up, closing above this fair value gap. Now we have aggressive price action here. And if we continue, we have fair value gap there, up once again right here. What do we notice? We close, we don't respect this fair value gap. Now we have aggressive move down, back into that fair value gap, aggressive move up. And that is how I look at displacement candles and use them to see what the order flow is doing. So now that you have an understanding what displacement candles are, we're going to take a look into what a market structure shift is. Now, a market structure shift is what indicates a change in trend from bullish to bearish or bearish to bullish. So in this case right here, we have a bullish move up, a market structure shift, and then the trend switches to bearish. Now, how do we identify this? We look for displacement below a previous low, or if it is bullish, above a previous high. And I also prefer to have a stop rate prior to this which also creates a breaker formation and creates high resistance liquidity for a stop loss. The most important thing I look for in a market structure shift is if price engaged a higher time frame level prior to shifting structure. If it did not, I do not personally search for a setup. So let's get into a few examples here of looking at market structure shifts. So if we're looking right here, we have previous day high marked out. And I do have 10 o'clock marked out because we did have some news at 10 o'clock. And we will watch to see if the move occurs then. So right here, we do engage into that higher time frame level. I'm going to go ahead and zoom in here. So if we're going to break structure here, I'd want to see this low broken here. So let's see what happens. Price reaches down but does not break it. Now we do make a new high. So if price is going to break structure, I'd want to see it break this low. And you can see we do not break structure. Now we make a new high. Now if we're going to break structure, we still have to break this low here. Not really a break of structure for me because we did not aggressively move below this low. So we're still looking at this low here. We do get a sweep right here. And this is a better sweep for me just because we don't close over that high. Now you can see we're getting big full-bodied candles reaching below this low. And we go touch midnight and come back up. So if we clean up this chart a little, you can see we have our liquidity sweep, and our structure shift is when we start closing and aggressively moving below this low. So we have a market structure shift. From here, then I can look for a setup, which what do we have right here? We have a fair value gap setup right here, as well as a breaker block. For added confluence, if we take a fib from low to high, we can see we also have an OTE right in there. So letting this play out, you can see price comes over, touches the OTE in a fair value gap within the breaker block. And what do we get right after that? We get displacement out of it. And you can see how the bodies respect the breaker block and fair value gap. So now we have another fair value gap. Price comes up into that, sweeps the current low. And from here, we would want to see London lows taken. So let's let that play out. And there we go. We get a move below our overnight lows. For this next example, we have previous week's low marked out, and we are on S&P futures on the hourly chart. So we are going to watch and see what happens when we engage this higher time frame level. So right here, we make an aggressive move into this area, and I would not be thinking long yet until we get displacement over this high. And right there, we get closure over this high and reach up higher. So this would be our market structure shift, and then I am focused on this displacement range. So from here, I can look at our discount and premium, and we have an order block sitting in a discount here. So I'd like to see this produce a reaction. Get rid of this, and let's see what happens. Right there, we get a nice reaction off of the order block in our midnight opening price. From here, I'd want to see it continue higher, and it does so throughout the week. For this last example, we are looking at DXY on the daily chart. So if you notice, we have a daily fair value gap over here, and price is drawing to here. So let's see what happens. Price raids this low right here into the daily fair value gap. If we were going to shift structure, we would need to break this high right here and close over it. Right there, we get a nice move over that high and closing. So now this high becomes a market structure shift, and I will look for price to go higher. From here, I look at my range where I have our premium and discount marked out. Do I have a PD array and a discount? I have an order block right here. So from here, I'd want to see price reach down into the PD array and respect it. So right here, price closes outside this order block, and then we move higher here. So in conclusion, what I look for is price to engage with a higher time frame level on a lower time frame, or that time frame, price to sweep a low or a high before closing over structure, making our market structure shift, and then looking for a setup on that time frame. If you do want to take a look at the PDF shown in this video, it will be linked in the description below. And please leave a comment if that is helpful, and I will look to continue to do that. I hope you enjoyed this video, and if you did, please like and subscribe, and I'll see you guys next time. How's it going, everyone? This video is going to be over market structure shifts versus versus liquidity grabs. In order to understand market structure shifts versus liquidity grabs, we have to understand what displacement is. If you haven't already seen my video on market structure shifts and displacement, I will link that in the top right corner, and I would recommend watching that first. But let's take a look into what displacement is. Displacement is a large aggressive move. It can be single or multiple candles that closes over structure. For example, right here, we have these 3 candles that make up a displacement move closing below this low. Really, my focus goes to this large candle that creates a fair value gap as our displacement candle. Similarly, over here, we have this large aggressive move that closes over this previous high. So what is a market structure shift? Market structure shift is when we get a sweep and then that large displacement candle or candles closing below structure, shifting the trend from bullish to bearish. Now, what is a liquidity grab? A liquidity grab, simply put, is a failure to displace over structure. So for example, here, when we move up, we fail to displace or get large aggressive candles over this high. Same thing right here, we reach over this high but close back in, and then we continue lower here. When we fail to displace below this low here, we look to the other side, and right here we get a strong aggressive move closing over this previous high, and we are likely to continue higher. Now that you understand the difference between price displacing and closing over structure, or failing to displace over structure, let's get into the charts and look at some examples. Before we begin this example, I'm going to show you what I look for in price at old highs and old lows. So if we mark out this high here, there's a few things that I look for when price returns to this area. Price is either going to displace out of this range, retrace and continue higher, or it's going to displace out of this range, displace back into the range, and then continue lower, or it's going to fail to displace over the high and then come back in. Those are the 3 things that I look for when price returns to an old high or low. So let's see what happens here. As we move forward, you can see price cannot close or displace out of this range. This leads me to believe that we're going to fall back into the range or head lower. So let's see what happens. Once again, cannot close outside of this range, closing back in. And there we go, we start to head lower. Now where do my eyes draw to? That we've disrespected this fair value gap, this low down here. So let's see where price goes. Price heads for this low. Now we're at this old low. What do we want to see? Price will either displace out, retrace, and continue, displace out, displace back in, go higher, or what is happening here, we fail to displace out. I'd want to see if these next candles don't displace out of this range, I'd want to see us come back into the range. Right there, we can't close out of the range once again. Once again, can't close out of the range, and then we start to displace higher here. So if you notice, can't close out of the range, displacement. We're likely to come back into the range. And for this, a lot of times I will use discount and premium because I want to see price return to at least a premium or a discount of the range if we are going to go lower. So right here, we haven't yet reached into a premium of this range. There we go, we reach into a premium, we displace higher. So right now, I'm thinking if we continue to displace higher, our eyes go to this high over here. Let's see what happens. Right here, not a very strong close up. Let's see what happens on the next candle. We don't respect this fair value gap, get a lot of displacement down, so my eyes go back to this low. Let's take a look at this low, see where price is going to draw to. So once again, price reaches for this low. What do we look for? Do we get displacement out? Yes. So we want to see, do the next candles retrace or do they displace back into the range? If they displace back into the range, we're likely to reach up to here. If they don't and they just retrace, then we're likely to reach lower. So letting this play. The retracement, very shallow. Don't really get any displacement back in, so we're likely to continue lower. Okay, let's take a look at this previous low now. Do we displace below it? Yes. Do we displace back in? A little bit, but we're respecting this order block. Now we're kind of consolidating here. And this is when other PD arrays come into effect here. Let's see if this order block stays respecting price. Okay. We didn't displace below this low. So if we are going to retrace, at least into a premium of this little range here, which we did do right here. Now I want to see the next candle if we displace up or if we displace out. So there we go, we get a closure outside this range. So I'd want to see if this order block is going to respect price as well, and we can continue lower. And there we go, we keep continuing lower and lower. And now I don't think reversal until we get some sort of displacement back up. Right here, we're starting to get full body candles moving up. However, if price closes below this low, it becomes an order block. So I want to see what the next candles do. Right there, we start to get displacement up. respecting this fair value gap still. So let's see what the next candle does. It closes higher here. Now we have a fair value gap here. So if price returns here, I want to see if it respects this displacement, move higher. And there we go. Start to move higher. Once again, respecting these bullish PD arrays. Let's see what happens. Now I'm starting to notice we have this old high. Can't really displace over it. I want to see what the next candles do. Right there, start to close over it. Pretty weak so far. Let's see if we are going to continue higher. I want to see aggressive candles like we did here and here. Okay, starting to come back into the range. Kind of just consolidating here. Okay, what do I notice here? Can't reach below there, so I'd want to see price return to at least a premium of this range. Reaches lower, closes back up. Right here, I'd expect price to reach back into the range or reach for this high depending on this next candle. Right here, we reach into a premium of the range and get an aggressive close out. My eyes now draw to these old lows over here. Closure below that low. You can see we close below this low, small retracement back in, close out. I'd want to see it reach for this low here. Get an aggressive displacement out of this range. So what can happen? Either a little retracement continuation, or we're going to displace back into this range and reach higher. No displacement back in, so likely to go lower. Okay, here we can start to see some aggressive candles in the other direction, right? Let's see if we get some displacement back in. Are we respecting bullish fair value gaps? Let's see, still closing outside of that. Let's see what the next candle does. That reaches higher, and where is this close? Over this high. So we can either get retracement for a continuation or displacement back in to reverse. So aggressive out, aggressive back in, likely to reverse here. And if you know the box setup, we could look for this previous high right here to resist price. Now back into this range, we close below this low. So I'd want to see it go a little lower. My eyes now are looking towards this low. Do we reach for it? No, we're starting to get displacement now down and back up. So where is my eyes looking at? These highs now. We respect the fair value gap. Let's see. We do. So now I want to see this high. Now, what do we get? Displacement out of this range. So we either get displacement back in for a reversal, looking for lows, or we retrace to continue higher. So there's displacement up. We're looking over. We do see this fair value gap over here. Okay, let's see if we get retracement or if we get reversal. So aggressive displacement out and displacement back in. I'd want to see it reach a little lower now. Now my eyes are over at these lows here, whether or not we take them. We do not, but we get displacement back up, which leads me to believe where. Where should I be looking? Old highs. Okay. Failure to displace. Reach back into a discount of this range. We're in discount. Price respects this fair value gap, so I'd want to see a continuation higher to this high and possibly that high. We take this high, get a close over. Looks like a retracement back in for closing back out in the range, so now I'd want to see this high taken. Displacement out. So do we see retracement or do we see displacement back in? And right there, start to close out, so I'd want to see it go a little higher. Still respecting. Now we get displacement out. But what do we get here? Displacement met with displacement. So now I want to see if we did go back into the range here. There we start to displace lower. So from here, I'd be looking left. What do we have to our left? We have lows right here. Letting price play out here. What happens? Not a whole lot, kind of consolidating here. You can see there is some down close right here, below this low. closes down, closes back in, we reach higher. Nothing really super convincing here. Okay. Now we reach for this old high. Do we displace out? No. There we get displacement down. Now my eyes are drawn towards these lows. Okay. Do we displace below these lows? Yes. So I want to look further left and down. Okay. Can't displace below this low. Met with aggressive displacement up. Where do I think we should go? These highs. Now you can see how on the 1 minute chart here, this can become a lot, right? We have a lot of structure breaks, a lot of failure to displace, just a lot of stuff going on. And that is why I think it is important to have some sort of directional bias. For example, if I'm bearish here, I'm not looking for any long setups. I'm looking for displacement down and a failure to displace up to position myself short. Similarly, if I'm bullish, I'm looking for displacement up and a failure to displace down to position myself long. Now we'll go through one more example, and this will be on the daily chart on how I use this to get daily bias. However, it'll just be an intro as my next video is going to go in depth on that. So an easy way to use displacement to find daily bias is essentially I find swing points in the market, so a swing high or a swing low, and then I look to see if price fails to displace or displaces out of that range. So for example, if we were looking at this high here, you can see price does not displace out of this range, and it returns back into the range. Now looking at this low here, price does not displace out of it, comes back into the range, and then it reaches for this high. Now what do we notice with this high? We get a closure outside this, or displacement out, and price reaches and continues out of this range. Thank you for making it this far in the video. I know it was a little bit longer, so please leave a comment below and let me know if you do like the longer videos, or if you like the shorter videos. If you are looking for the PDF, it will be linked in the description below, and if you do enjoy my content, please like and subscribe, and I'll see you guys next time. How's it going, everyone? This video is going to be over fair value gaps. What is a fair value gap? What is a BISI? What is a SIBI? What is consequent encroachment? As well as inversion. We will also touch on the difference between a fair value gap, a volume imbalance, and a gap. The first thing we are going to go over is what is a fair value gap. A fair value gap is a 3-candlestick pattern where the first candle low does not overlap with the third candle's high, or where the first candle high does not overlap with the third candle's low. Let's take a little bit of a deeper look into that. If we take a look at this candle's low and drag it out, and this candle's high and drag it out, because this high does not overlap with this low, this is now a fair value gap. Going over to this example, this candlestick high does not overlap with this candlestick's low, so this is also a fair value gap. So now that you understand what a fair value gap looks like, what doesn't it look like? If we were to extend this candle's low down to here, and this candle's high up to here, let's drag the high and low across and see if there is a gap. When dragging the high and low across, you can see that they overlap. The low from the first candle is lower than the high of this third candle, so there's no gap there, and this is not a fair value gap. Similarly over here, if we were to extend this high up and this low down, you can see that there is overlap between the first candle's high and the third candle's low, meaning there is no fair value gap here. So just to clarify, a gap between the first candle's low and the third candle's high, or the first candle's high and the third candle's low, is what creates a fair value gap. Let's go over a few examples of finding fair value gaps. So if you look right here, we have our first candle's low, extend that out, and our third candle's high, extend that out. There is a gap between this candle's low and this candle's high, and that creates a fair value gap. Now if you notice, do we have another one? Yes, because this candle's low does not overlap with this candle's high. So now we get an aggressive move in the opposite direction. And looking at this candle right here, 1, 2, 3, this candle's high does not overlap with this candle's low, which creates another fair value gap. The next thing we are going to go over are SIBIs and BISIs. A SIBI is a sell-side imbalance, buy-side inefficiency. What does that mean? It means that sell-side was offered, but buy-side wasn't, so it is inefficient, or simply put, a bearish fair value gap. A BISI is a buy-side imbalance, sell-side inefficiency. This means that buy-side was offered, but sell-side wasn't, so it is inefficient, or a bullish fair value gap. So if we look at this price action right here, we have a bearish fair value gap where sell-side is offered, but buy-side is inefficient, so this creates a SIBI. Now if we move over here, and let this play out, you can see price made a bullish fair value gap here, or a BISI, because it offered buy side but not sell side. And there we go. There's an example of a SIBI and a BISI, and I hope that clarifies some things for you guys. There are three things that I look for within a fair value gap. The first being the start of the fair value gap, the second being the consequent encroachment, or the 50% of the fair value gap, and lastly, where price completely fills the fair value gap. When price returns to the fair value gap, I want to see a few different things. One, price can either reach up into this fair value gap, close out, and continue lower. It can also reach up into the consequent encroachment of this fair value gap. From here, I would like to see a candle close outside of it, but as long as it's respecting the consequent encroachment, I'm pretty flexible with that. It can also reach up, fill the fair value gap, and with this, I prefer to see price close outside the consequent encroachment of this fair value gap. The one thing I look for when I'm invalidating a fair value gap is this close. When we start to close over the consequent encroachment or outside of the fair value gap, price is not respecting that, and a lot of times price will not reverse back down. Going back to our previous example, we have a SIBI right here. Let's mark out the consequent encroachment and see what happens. And so you can see when we reach up into this fair value gap, price does not close over the consequent encroachment. Now, for example, let's take a look at this SIBI right here. Marking out the consequent encroachment, you can see that price did not respect this SIBI at all and closed right through it. This is when I will invalidate a fair value gap because price is not respecting it. Now, if we take a look at this BISI right here and mark out the consequent encroachment, let's see what happens. Price reaches into the fair value gap, closes out, so it is currently respecting. However, if we take a discount and premium of this range, I would like to have it reach a little bit lower to reach a discount of the range. There, price, you can see, we touch the consequent encroachment, close outside of here, and get a continuation higher. The next thing we're going to look at is fair value gap inversion. And what that is when a fair value gap fails, or price closes through it, this fair value gap can then be used as support or resistance. So then I would expect price to, if it does, return to this old SIBI, use it as support, and move away. And over here, if it returns to this old BISI, use it as resistance, and move away. One thing is that this doesn't need to occur back to back, or these fair value gaps don't have to overlap. This can occur later on after a period of consolidation. Going back to this previous example, we have a SIBI right here. Price closes through it. I can then look to see if this SIBI supports price, which it then does before getting a move higher. Here's an example of what I mean when I say that fair value gap inversion does not need to occur back to back. So as we watch this play out, our first clue is that this close below the consequent encroachment. We cannot displace back out, hit this wick right here, come back in. Let's see if we can close below the fair value gap. And right here, we get a close below the fair value gap. Extending this out, let's see what happens when price returns to this. You can see price returns to this BISI, this old BISI. It then uses it as resistance to go lower. For our next example, we have a SIBI right here. So let's see how price reacts to it. And you can see we filled this fair value gap and price closes out of it. So it's currently respecting it. It takes sell side liquidity, comes back up, still respecting the SIBI as it closes out of it. Takes sell side liquidity again, comes back up, still respects it. We open up, and right here we close over this SIBI. So extending this out in time, let's see what happens when price returns. You can see how the consequent encroachment was used as support. And then going even further ahead, we reach into this old SIBI again, use it as support, and get this placement back out of it. The last thing we're going to cover in this video is the difference between a fair value gap, volume imbalance, and a gap. We already discussed what defines a fair value gap, so let's look into a volume imbalance and gap. A volume imbalance is a gap between the closing and opening price of two candles, and the difference between a volume imbalance and a gap is a gap has a complete absence of trading between two candles, while a volume imbalance had trading or overlap between the high and the low. A quick example of a volume imbalance would be from this closing price to this opening price, we have a gap. However, price did trade through these areas, so it is a volume imbalance and not a gap. And so when price returns, we get a nice reaction from that area. And here's an example of a gap where between two candles, we have a complete absence of trading. I hope you found this video helpful. If you did, please consider liking and subscribing, and I hope you have a great rest of your day. See ya.
How's it going, everyone? This video is going to be over order blocks. We are first going to cover order blocks at the smart money reversal before talking about order blocks on the buy side and sell side of the curve. I'll also be talking about the mean threshold of order blocks, what it looks like when price is respecting an order block versus invalidating an order block. And then finally, I'll be taking a look at stop losses for order blocks. So let's hop into the PDF and get started. So here we are on the order block slide. And if you notice, we reach into an important level. We create a high or buy side liquidity, we sweep that high and then displace and close below the opening price of this single or series of up close candles into this important level. This candle here displaces and closes below the opening price here, validating it as an order block. Then when price retraces back into the order block, it is used as resistance to continue lower. Similarly down here, price reaches towards an important level, creates sell side liquidity. It then sweeps that sell side liquidity before displacing and closing over the opening price of the single or series of down close candles. Once this occurs, price then uses this level as support to continue higher. Now, order blocks don't necessarily need a sweep before this closure below, creating a high, low, higher high, lower low, but I do prefer that, and so I always wait for a sweep. Now, the most important part on this slide is waiting for an important level. If we get this pattern at a random spot in a chart, it doesn't mean anything. That's not an order block. It needs to be off a higher time frame TD array or important level. So here we are with our first example, and if you notice, we have buy side liquidity resting here, or buy stops. Here you can see we sweep those buy stops right here. Now, if we get a close and displacement below the series of up close candles here, this opening price, we now have an order block. Let's see if that forms. So right here, we get displacement and closure below that. So looking to enter on a retest of the order block, my stop on this high, and looking for 2R. Let's see how this works out. So here we get tagged in. And there we get stopped out. So now why did we get stopped out? Now, if you remember back to the slides, I'm looking for the series of up close candles into what? An important level. Do we have an important level here? Well, if we're on the 5-minute, let's zoom out to the hour. Here we have our buy side liquidity resting right here. So zooming back into the 5-minute, now you can see in the absence of a higher time frame level, these up close candles just created equal highs, and this is a retracement to move higher. Now let's go back to the hourly chart and see how we could frame this in the other direction. So back out here on the hourly chart, knowing we have buy side liquidity resting above us, what do we have right here? We have a fair value gap. So with an hourly fair value gap, dropping down to the 5-minute chart now we are waiting for price to reach into the fair value gap. Here we get to reach into the fair value gap. So now what do we have checked off? We have an important level. So now I'm waiting for a sweep. Here we get a sweep. Now, if we're going to validate this down close candle into an important level and sweeping liquidity, where do we need to close? I want to see a closure over the opening price of this down close candle. And here we get that closure. But once again, looking to take an entry on the retest of this opening price, my stop on the low, and then looking for buy side liquidity or 2R. Let's see how this works out. And you can see we hit our TP. So you can see this is not a valid order block because it is lacking a higher time frame level, while this order block reaches into a higher time frame level or an hourly fair value gap and is going with the trend. Now let's hop back into the PDF to learn about the mean threshold of an order block, as well as the order blocks on the buy side and sell side of the curve. So what is the mean threshold of an order block? Well, you just learned what an order block was in the previous section. So taking a look at the order block, the single or series candles, I'm going to take my 0.5 fib from the body low to body high and mark out 50% of that order block. That is our mean threshold. Ideally, if price is going to respect this order block, I don't want to see any closes below the mean threshold or 50% of this order block. So you can see here, once we validate this order block, the 50% level of the order block is respected to move higher. Now, lots of times I will focus on using the mean threshold of an order block when we have a larger series of candles in which the opening price does not make sense for an entry. Let's hop into an example of that. So here we are on oil 5-minute chart, and you can see we're reaching into an hourly fair value gap here. Although we do have a little sweep here, I prefer a nice swing low to be swept. But let's see if we can close over this down close candle. You can see we do not get a close below, and then now what are we getting? Another lower time frame sweep. Here we get an extra little sweep. And now what I would be looking for is where is the series of down close candles? Right here. So I want to see price close over these candles here. And there we get a close over those candles. This is our order block here, or the series of down close candles before the change in the state of delivery. My eyes are drawn to these failure swings up here, So if I was looking to take an entry off of this order block, I'd need my stop on this low, or that is how I do it, and then targeting the failure swings at the high. However, that gives a risk to reward ratio of 1.3. So this is when I would go from body high to body low and mark out 50% of that order block. Now I can look for the mean threshold to be an entry point, and you can see how my risk to reward goes from 1.3 to 2.6 almost. Let's see how this plays out. You can see it takes a good while, but we do reach those failure swings up there. You can see from this example, it's not always going to be super clean and picture perfect. But when I have a larger order block or larger series of down close candles where it doesn't make sense to enter off the opening price, that is when I will look to enter off the mean threshold. And zooming out quickly to look at the hourly chart, you can see how the bodies respect the fair value gap here and the wicks do the damage. So now taking a look at order blocks on the buy side or sell side of the curve. In this case, we'll be focusing on the buy side of the curve for the PDF. Now when we switch from bearish to bullish and we have our smart money reversal, I will still be looking for entries after the smart money reversal. And the way I do that is I look for an order block on the buy side of the curve. Now, what am I looking for? I'm looking for a down close candle into an important level. Now, those important levels are a previous order block, a fair value gap, or a sweep. Let's go over those. So you can see here, this would be our smart money reversal. We have an order block. We get a down close candle into that order block. We close over this down close candle, validating it as an order block, and then price continues higher. The next one I look for, the down close candle into the fair value gap. When the opening price of that, or the series of those candles gets closed over, validating it as an order block, I'll look for an entry higher from there. And the last one I look for is similar to the smart money reversal, but in a continuation of a trend. We have a swing low, which is swept, and then the down close candle that swept this low gets closed over, validating it as an order block to continue higher. Let's hop into the chart and go over a few examples of these. So in this next example, you can see that price has mostly consolidated through Asia and London. So let's see what happens as we near New York open. You can see here, we sweep these lows over here, or these sell stops resting below the Asia lows. Now, if these down close candles are going to become an order block, what do we have to do? We have to close over the series of down close candles right here. So let's see if that occurs. So we do get that close. Now, if I'm looking for an order block entry, I would look to enter here, my stop on the low. However, with this current range, if I was just targeting these highs here, that's 1.4 risk to reward. Now, there's a few ways I can go about this. I can look for a fair value gap entry, which should give me just about 2R, which I'd be looking to do. But let's see if price confirms the smart money reversal, and then we can find another order block. So here price reaches into an important level or a fair value gap. So if it's going to close over the bodies of these series of up close candles, this is now an order block. We cannot close over those bodies yet. And what do we get? We get a sweep of a low. Now if we're looking for the lowest body down close candle, it would be this candle here. I'm waiting for price to close over that candle. We do not get a close yet. And there we get a close. So now if I'm looking to take an entry, I can enter on the opening price of this down close candle, my stop on that low, and then targeting the highs for just about 2R. So you can see it's about the same as that fair value gap entry. And there it goes. Now, if we're going to look a little bit deeper at this price action and use what we learned in the last section, we can mark out the mean threshold of this order block right here. You can see that the candles respect this mean threshold. Now what I can do is look to take an entry on this mean threshold with my stop in the same spot, and you can see how the risk to reward significantly increases. However, with this technique, I also risk the chance of not getting filled on this trade. Now you're probably wondering, can we do the same thing with this order block down here at the smart money reversal? And of course we can. So marking out from the high to the low of the bodies and dragging it over, let's see how this risk to reward would be. Entering at the mean threshold, my stop on the low, and targeting the same highs, it would be just about 2.6 when compared to the fair value gap entry at 1.95. Let's go over one more example of using order blocks as a continuation of trend. We have previous month's highs sitting here. You can see we create equal highs, and then we have a series of up close candles into the equal highs, which then get displaced and closed below, validating it as an order block. Price then retraces back up into the order block, as well as into this small inefficiency here, or fair value gap. Now we have a series of up close candles into an order block and fair value gap, or important levels. So now if price is going to displace and close below these up close candles, we now have another order block. Here we displace and get a close below. Now let's see if we reach back up into that important level. Here we reach up into this important level, so now I can look for this to displace and close below. We do validate this as an order block, so now I can look at this as another point of interest for continuation of trend. And there we reach into this. So now what do we have? The up close candles into an important level. And let's see if we get a move lower here. And we do. So you can see how these order blocks are formed when they reach into an important level and then displace and close below them. Now you're wondering, why didn't I choose this candle as an order block? Well, it never reached up into an important level for me. I wanted price to reach back into this order block, which it did here. So although we close below the opening price here, it doesn't validate it as an order block for me because it's missing that important level. Now the last thing I'm going to talk about prior to our final example are stop losses with order blocks. Generally, I'm looking to place my stop loss on a swing high or low or the other end of the order block. Now obviously a stop loss on the other end of the order block will provide higher risk to reward than the swing low, but there is the chance that price will wick the stop loss even when the trade is not invalidated. Let's hop into our final example. So let's take a look at this example and work through it. If we are looking for a continuation of trend, what is our draw on liquidity? Well, it would be this high up here or buy side liquidity. Now, if I'm looking for continuation of trend, I'm looking for either a return to an order block, a fair value gap, or a sweep of a low. Well, if you notice over here, we have these down close candles that swept all these lows down here. So this also creates an order block and it has displacement following it with a fair value gap. With that idea in mind, to run lower, to go higher, what else do we see? Well, we have lows resting here or sell stops. So let's see what happens after open. Now I don't need to catch this first entry and I'll show you this. So here you see that first entry, we never violate this low over here, but what do you notice? We have down close candles into order block, fair value gap, and sweeping lows before displacement and a close over these down close candles. So what is this? That is an order block. So now I can look to take an entry here, I stop on the low, and we created equal highs up here, and that is only 1.5 R. Now although that is great, what can we do? Well, we could mark out the mean threshold of this order block. And if you notice, that also lines up with this little inversion here. But if we're going to take an entry here, that is 2.5 R. So let's see how that works out. And there you go, we get a move higher and hit our take profit. So you can see, even if I don't catch this first initial buy, this order block is a secondary entry to move higher. Now this isn't the best example, but if I was to have my stop on the order block low here, and this moved just 1 point lower, it would have stopped me out, even if the trade was still valid and didn't violate this low. That's why I personally prefer to have my stop on the swing low and adjust my entry to get closer to my invalidation point, rather than adjust my invalidation to get closer to my entry. I hope you found this video helpful. If you did, please consider liking and subscribing, and let me know in the comments below which video you prefer between mitigation, breaker, and propulsion blocks, as those are the videos I will be looking to do next in this series. I hope you guys had a great holiday, and I'll see you guys in the new year.
How's it going, everyone? This video is going to be about entries, specifically taking daily bias and then dropping to the lower timeframes to gain entry. Since releasing the daily bias video, this has been the topic I've gotten the most questions on, so it felt fitting to make this my next video. Now, I've already made a video on building an entry model. If you haven't seen that, I'll link it in the top right. However, if you have seen it and would like me to remake it, please let me know in the comments below and I'll be sure to get to that. The thing we're going to do is hop over to Twitter and go to the MMXM Trader's Twitter page. If you don't know who he is who taught me a lot of what I know, so we'll go to his page for an example before we go back to TradingView and find some of our own. So if we scroll down his page here, here's the example we're going to focus on. So if we go ahead and zoom in here, we'll go ahead and look at the daily chart. So here we are on the daily chart. Let's take a look and see how he framed this trade. So we'd go in, put in a swing low here, return to the fair value gap, fill the fair value gap here, and then he anticipates a move towards this sell side liquidity and this low resting below. So with that idea in mind, looking for short setups in here. Where does he go from here? He drops down to the hourly chart. So here you can see we reach into this point of interest or fill the daily fair value gap, and then we shift structure bearish. From here, we get a retracement back up, reach into a breaker block plus the fair value gap before it trades lower to that sell side liquidity. So let's go look in here and see what he uses to frame an entry. So here we are on the 5-minute chart. Here you can see the hourly breaker and fair value gap. We reach up into that, displace lower, put in a lower high, lower low. We start to trend lower, and then he takes an entry here on this 5-minute fair value gap fill, targeting lower prices. So what can we learn from studying this example? We know we started with the daily chart, and then from there went to a lower time frame to get a point of interest, and then from there went to another lower time frame to get an entry. So let's hop back into TradingView and go over a few more examples on the charts. So in this example, we are watching NASDAQ on the daily chart, and it is going to be focused on the 24th of August. Now, if you notice, we already took a swing low, reached our 2.5 standard deviations, and we get an aggressive move up on Monday that continues into Wednesday. Now here I'm noticing we failed to displace over this swing high, so that leads me to believe that there may be downside. Now the next thing I'm going to mark out is previous day high and low. And I will also mark out this daily order block here. As if we reach up higher, I would expect this to resist price. From here, I'm going to drop down to the hourly chart to see if I have a point of interest that aligns with my bias, which is bearish. So here we are on the hourly chart, and we'll go ahead and move it forward to see what happens. So as we reach into midnight, we're going to go ahead and mark out our midnight open. And let's see what happens during London. What I notice here is London sweeps these highs, but can't displace above them, and we start to move lower. Let's see what happens as we come closer to New York. So as we come into New York here, we get a move above the daily open, we close back in, and then we get displacement lower, making and validating this order block. So marking out this order block, this is my point of interest going into the New York open. Let's go down to the 5-minute chart. So here we are on the 5-minute chart. This is our hourly order block, and this is our previous day high. You can see we already reach above our daily open and displaced back lower. So I'm interested in price once it reaches up into this area. Letting this move forward, you can see we use a fair value gap here to reach up into this hourly order block. Now I want to see if there's a reaction off of this PD array to give an opportunity or present an entry. So we get displacement down. What I see here is a high, low, higher high, lower low. So I'm going to mark out this candle here as a breaker block. Then I can anticipate this area resisting price, and I would not want to see price reach up into this high. From here, I can mark out my minimum 2R before I leave runners. So let's see what happens. So it tags us in prior to 9:30 open. At 9:30 open, we get expansion lower. And let's go out to the 15-minute chart to see what happens. So if you remember, we marked off our previous day low as well. And then we expand to our previous day low. Now I hope in this example you can see how I use the weekly profile and daily bias, and then using that daily bias dropping down to the lower timeframes to gain entry. So let's hop into another example. For this next example, I'm going to be looking at Tuesday, August 15th. And what I notice here is we have an up close candle. And on Monday, price moved up and closed into this. Now, if this up close candle is going to become an order block, I would like to see it close and reach below previous day low. So I will also mark out our previous day high. So let's drop down to a lower time frame and see what this looks like. So here we are on the hourly chart. I will want to see what happens at midnight. So we'll go ahead and let this play forward. Price moves up into this order block, and then midnight open is right here. We start to reach higher, and there is our displacement prior to New York. We sweep under this low into this fair value gap. Now from here, we have an up close candle. Let's see what happens after that. So price goes and reaches below this low. Now I'd want to see this close below. There it closes below. So I'm anticipating this to support price lower to where? Previous day low as marked out here. So now we have a point of interest. Let's drop down to the lower time frame and see what happens. So I want to see what price does as we reach towards 9:30. So let's see what happens here. And I want to see how price reacts around this area. So there we go, we reach up into this area, and this is actually an SMT from this high down to here, which is important to note. And then we get another sweep, still not taking out this high, so the SMT is still valid. We get our displacement lower. So what does this create? A fair value gap. So looking at this fair value gap, I can mark that out, use the consequent encroachment of it, and from here I can look for an entry with my stop on this high and my target just below our previous day low to get my minimum 2R. And let's see what happens. We reach up into this fair value gap, forms an up close candle, and then we start to displace lower, and there we go. So you can see we started out at our daily, went to our hourly, got our displacement lower. Here we have an hourly order block as our point of interest. SMT is confirmation, and then our 5-minute entry targeting our previous day low. For this last example, we are going to be looking at NQ on Thursday the 17th. Tuesday has made the high week, so I'm anticipating expansion into Wednesday and Thursday. We have an up close candle, which is resisting price lower, so I'm anticipating Thursday to reach previous day low, as well as this swing point over here. So let's drop down to a lower time frame and see what it looks like. So here we are on the hourly chart, and I notice this price action right here. We have an up close candle where we reach into a fair value gap and displace lower. So I would not want to see price reach much higher than this order block here. So marking that out, I want to see how price moves into and before the New York AM session. So currently bullish PD array is being respected, which I would want as we reach higher towards this order block. So here we reach into this order block. So let's go down to the 5-minute chart and see what it looks like. So here we are on the 5-minute chart. You can see we already at 8:30 news. We retch up, hit this order block. Now we put in a down close candle. So we put in a high, low, higher high. We put in a lower low. This becomes a breaker block. There is displacement paired with a breaker. So if price returns back up into here, I would anticipate it to hold. Would not want to see this high hit. Minimum 2R. And then where would I want to see runners go for? That swing low down here. So let's see what happens. Right there, gets tagged in. And we expand lower, hits 2R almost immediately. And then let's see what happens here. And there we go, we hit that swing low. So in this example, you can see how I use the daily time frame to anticipate a move lower, and then use the lower time frames to gain an entry into that. As always, thanks for watching. Hope you enjoyed the video. If you did, please consider liking and subscribing, and I hope you have a great rest of your day. I'll see you guys in the next one. How's it going, everyone? This video is going to be over ICT's power of 3, or accumulation, manipulation, and distribution. We will first briefly go over what open high low close and open low high close is, before jumping into what the power of 3 is, how to identify it, and some examples. Now before we begin, the most important part is to have some higher time frame order flow or drawn liquidity. There has to be some sort of narrative, or you are just trading patterns. So what is open high low close and open low high close? Open high low close and open low high close just refer to the open, low, high, and close of a higher time frame candle. So for instance, if this is the daily candle and this is the intraday price action, price opens, puts in a low, makes a high, and then closes. Similarly down here, price opens, makes a high, puts in a low, and then closes. Now the goal is to catch the expansion move or the bulk of the intraday range, and that is where the power of 3 comes in. So the power of 3, or AMD, refers to accumulation, manipulation, and distribution. Now accumulation is a range or a consolidation. Now what this does is creates buy stops above old highs and sell stops below old lows. Now when we enter manipulation, it is a false breakout outside of this range. What this does is stops out any longs entering during accumulation, as well as induces breakout sellers into the market. Then price distributes higher and completes that power of 3. So you can see here, accumulation manipulates. So what this does is induces breakout buyers and runs shorts out of their positions, and then distributes lowers. So let's go ahead and overlay this on the last example. So here you can see we have accumulation, manipulation, which stops out anyone long in here, as well as sellers are going to enter the market playing this breakout, and then price reverses and distributes higher, creating the daily range. Similarly down here, price is consolidating, any early shorts gets stopped out, any breakout buyers enter the market, then price reverses and distributes lower. So how and when do I look for entries using the power of 3? Well, there are two ways I look for entries here. The first would be within the manipulation. I'm going to be looking for reversal patterns here in the manipulation, looking to catch this whole distribution. However, if I miss this or do not like to trade this, I will be looking for a continuation entry in this distribution. So going back to our example here, for these longs, I could be looking for a reversal here within the manipulation, or looking for a continuation pattern here, looking for higher prices. Similarly down here, I could be looking for sells on this reversal here, or looking to trade this continuation lower. So let's hop into the chart and look at a few examples of this. So here we are on the charts, and the first thing I want to talk about is this concept is fractal. So I can use it on the lower timeframes as well as the higher timeframes. We're first going to go over some examples on the lower timeframe, and then work our way to the higher timeframes and the intraday profile. So if you notice here, we have New York open, making this move up, and then all the way back down. So marking out this morning's low, let's see what happens once price takes this low. So you can see price took this low, and we are creating a range or a consolidation. So let's go ahead and mark this out with a green box. So now what is happening here? Liquidity is being built above this high and above this low. So if I'm looking for price to continue lower, I'd like to see manipulation out of this side of the range to go lower. If price is going to reverse and go back higher, I'd like to see it manipulate down first and then distribute higher. So let's see what happens. So here you can see we get an aggressive move down, which is out of the range, sweeping this low, and then aggressively back into the range here. So this would be our deviation from the range or our manipulation. So now from here, I'm going to be looking for an entry long. However, I'm not looking for a market structure shift because we would need to break this high up here. So what I can do here is look for an inversion, or I can also look for the box setup, which would be taking this previous body's low over here. So now what I'd look for is price to reach into this inversion now that it is closed over, my stop on this low, and let's say I'm looking for 2R. And there we go, we get our accumulation, manipulation, and let's go ahead and remove this so we can visualize the distribution, which is here. So you can see that is our power of 3, or our accumulation, manipulation, and distribution. So here we are on the 5-minute chart, moving up from the 1-minute chart, and take a moment and look at this price action, and what do you see? Now you might see the failure swings right here on this high, and we have sell side liquidity resting right here. So let's see what happens here as price continues. Now if you notice, we have a consolidation right here, and we are leaving this range aggressively. We sweep this low, and now we get aggressive movement back into this range. So we have our accumulation, our manipulation, which not only took the lows from our consolidation here, but also sell side liquidity here. And so now what can we anticipate? We can anticipate distribution or a move up to these failure swings. So looking at it, where could we get an entry? Well, we have an inversion right here. So looking to take an entry here, my stop on this low, and then my target on this high. Let's see how this works out. And it was pretty messy price action, but you can see that we do in fact get our distribution above these old highs. In this example, we will be taking a look at the power of 3 for the daily candle, or anticipating the open high low close or open low high close. So here we are just after midnight. Let's go skip forward to the London session. So you can see as we're entering the London session here, what do we have right here? We have a consolidation range. Now what happens during London? We're getting an aggressive move down. Is that met with an aggressive move up? Yes, we put in a down close candle here, close above it, retest it here, and are moving higher. So this is our manipulation. So what can we anticipate? We can anticipate distribution higher into the end of London and New York session. And if this is correct, this will be the manipulation of the daily candle and create a wick. So here we start to move higher. And there is our New York open, and we move higher and higher here. So you can see London sets the low a day here after manipulating the Asian range, and then we distribute higher through the New York AM session. And zooming out and letting this continue until the end of the day, you can see we put in an open, low, high close. Our London was the manipulation, creating the wick of the daily candle, and then we got the distribution or the expansion of the daily candle. So let's take a look at our next example, once again using the daily candle's power of 3. So here we have midnight open. Let's go to our London session. So here we are in London session, and what do you notice about this price action here? All we did was consolidate. So let's go ahead and mark that out as our accumulation. What's happening here in London is we are manipulating. So let's see if this is met with an aggressive move back into the range, because if we fail to displace back into the range, we're likely to go lower. And here you can see we get our accumulation, manipulation. We aggressively displace out and back into the range. So here is our manipulation. And now what can we anticipate? Distribution higher. So looking for distribution higher here. So let's let this play out and see what happens. And there you go. You can see we get our distribution higher. So once again, looking back, we have accumulation of the Asian range, London manipulation, and then distribution into the New York open. However, at the New York open, we do reach into this new day opening gap. So let's go ahead and mark that out. Now let's drop down to a lower time frame and see if we can spot another AMD. So down here on the 1-minute chart, here is our new day opening gap and the consequent encroachment of it. What do we notice about the price action prior to the New York open here? It is just consolidation, right? Then what do we have? We have an aggressive move out of the range here. Now at this point, we're still respecting the New York opening price and this down close candle. So I'd want to see further displacement down to confirm this idea. So here we get that aggressive move down now. So what can I anticipate? Some form of distribution lower. Now, some of you might be asking, how do I know how far this distribution is going to go? And that is generally when I like to project the manipulation. So here I would be projecting from this low to this high, because that's the low that made the manipulation move. And it's more visible on the 30-second chart. So we will drop down to that. So you can see this is the low that made the new high before we reversed. So going back to the 1 minute chart, this gives us some targets for this distribution. So here we have the 2 to 2.5 and then our 4 to 4.5. So from here, do we have any PD arrays that line up with that? Yes, we have some equal lows right here. And then zooming out, we have that London manipulation that lines up with the 4th standard deviation. So let's see how this plays out. So we hit our first standard deviation, get a retracement to an up close candle. We go lower into the 2 to 2.5 standard deviations, and there we just go sweep those lows. And then letting this speed up, you can see we put in more equal lows here, leaving the London low. And then there we take the London low into this area here. One thing I'm going to go over quickly is many people struggle to find the consolidation. Instead of focusing on the consolidation, just focus on where there is aggressive price action out and back into a range. So for example here, after we hit this London low, let's see what happens. Here we get an aggressive move down and then back into what range? Right here. I have now identified this consolidation, and then here's the manipulation. So I'd want to see distribution above this high and possibly up higher. Letting this play out, you can see we get aggressive move over this high, and then now we get an aggressive move back into this range. So now what is happening? Let's zoom in a little. We just identified the aggressive price action here. Where is the aggressive price action here? Right there. Now we can identify this consolidation, and then where would we want the distribution? Lower, below this low. And if we're going to get a continuation lower, what is the low that made this high? Right there. So let's see how this one plays out. And you can see how we had accumulation, manipulation. We do distribute over this old high. However, when we displace back into this range, we enter a new accumulation, manipulation, distribution, and this one is going with the higher time frame trend. And the whole point of this segment of this video is if you struggle to find the consolidations, focus instead on the manipulations and then identify the consolidation range in which this manipulated outside of. So here we are with our last example, and let's move towards our London session to see what happens. Here we enter our London session. Now, if you haven't already identified the accumulation, let's take a look at the manipulation and then work backwards. So here you can see we get an aggressive move out and then back in. So marking this out, and we look left, where is the range that we manipulated out of? Right here. So here is our manipulation. Now, where is our accumulation? We mark out this range. So anticipating distribution, where can we anticipate that to distribute to? Here I can use a projection of this manipulation leg. So from this high to the low that made the new high, which would be right here. And if you can see, price went up, then down, up again. This is where I'd want to see price go to. So marking out the 2 to 2.5 and the 4th standard deviation, I'd want to see price reach for these areas. So visualizing the distribution, I'd want to see price reach or do something like this. Now, what would that mean for the daily candle? That would mean that from our open here, this is the manipulation of the daily candle, which should create a wick. And then I'd want to see the daily candle form as it moves lower. So let's see what happens. And if you know the box setup, you know that a possible entry lies right here when we retest this deviation from the range or the manipulation. Here we reach into the 2 to 2.5 standard deviations, where we can anticipate a retracement or a reversal. And you can see how this daily candle is starting to form. Here we get a retracement back into a fair value gap and these up close candles here, and we start to distribute lower. And there we reach our 4 to 4.5 standard deviations. Here I am happy with the overall range of the daily candle, but let's see if it expands lower. And you can see it doesn't do a whole lot after that. Now, taking a quick look at this, you can see we have our accumulation, our manipulation, and this manipulation above midnight open will form the wick of the daily candle, and then we get our distribution creating the body of the daily candle before it closes. I hope you found this video helpful. If you do want a part 2 of this where I go over AMD paired with standard deviations, let me know and I will work on that. If you are looking to get some more information on standard deviations, I will also link Dexter Labs' Twitter in the description below. And I hope you guys have a great rest of your day, and I'll see you guys next time.
How's it going, everyone? This video is going to be over standard deviation projections. Standard deviation projections can be used to find targets, areas to expect retracements or reversals, as well as a confluence to an existing strategy. This video will be focused on the settings of the Fibonacci, which price leg to project, which areas to look for a retracement or reversal, what to expect after hitting max expansion, as well as pairing with PD arrays and overlapping existing projections. So let's get into it. So the first thing we are going to go over are the Fib settings. So if you see here, we are using a Fib retracement tool on TradingView. And the settings we have here are 1, 0, -1, -2, -2.5, and -4. And if you specifically want to see the color I'm using, it is right here, and my background is very transparent. I have my values on the left side in the middle with a font size of 10. So now that we have our settings, let's get into how to anchor this Fibonacci retracement tool. So here's an example of what the Fibonacci tool will look like once it is projected out. However, where do I anchor this Fibonacci tool to get these projections? And that is what we are going to go over next. So when price creates a smart money reversal or a reversal pattern, so for example here, price is trending up, makes a high, low, higher high, lower low, I'm going to look for the manipulation leg. And that manipulation leg is the swing that swept liquidity before changing the state of delivery or shifting structure. So for example here, this low to this high that swept liquidity, that will be the manipulation leg. I then take my projection tool or my Fibonacci retracement tool and project this out such as so. So let's get into the charts and look at a few examples of projecting these out before we get into the rest of the PDF. So here we have price action trending up. Let's see if we get a smart money reversal. And here you can see we get an aggressive price action out and then back into the range if you've seen my last video on accumulation, manipulation, and distribution. So where is the price leg that made the new high before the new low? And so from this low to this high, that would be the manipulation leg. And so projecting that out from our high to our low, you can see we get our projection put on the screen here. So let's go to a few more examples of just projecting this out. So here we have price kind of consolidating. Let's see what happens. So we get an aggressive move out and then back into the range, changing the state of delivery. So where is the manipulation leg or the leg that made the new low before the new high? So from right here at this high to this low, that would be the manipulation leg. So projecting that from our low to our high, we have our projection. So here we are, we have price trending up. And there we go, we get a sweep and then displacement down. So take a moment, where is this manipulation leg? So you can see price from this low made a new high before displacing down. So our manipulation leg is from this high to this low or from this low to this high. So then projecting it out, I go from this high to this low and have my projection. So now that we have practiced identifying that manipulation leg and projecting it out, let's go back to the PDF and see what we are looking for in these projections. So here we are back in the PDF, and although there are many ways to use these projections, we're going to focus on the -2 to -2.5 and the -4 as areas of interest. So when price reaches the -2 to -2.5 standard deviations, I'm looking for either a retracement or a reversal from this area. If price displaces and closes through this area, then I'm looking for the max expansion or the -4 standard deviation. Once hitting max expansion, what I can do is mark out a discount and premium of this leg here and look for price to retrace to an equilibrium. The next thing I want to talk about is pairing these standard deviations with PD arrays. For example here, the -1 has a fair value gap lining up with it, and then the -2 to -2.5 has sell-side liquidity resting between them. I personally love to use these projections and then see if it lines up with equal highs or a fair value gap or some sort of PD array. So let's go back into the charts and look over these concepts. So here we are back with our first example. Let's go ahead and mark out these areas and then look to see if any PD arrays line up with them. So marking out the 2 to 2.5 standard deviations, as well as the 4th standard deviation, let's see if any PD arrays line up in these areas. So if you notice, we have sell-side liquidity resting here, as well as here. Because this is just right above the -2 to 2.5 standard deviations, I consider this the low-hanging fruit. Then we can mark out the sell-side liquidity resting within this area here. So let's see how this plays out. And another thing you can do is when we get another manipulation leg, such as here, we can also project that out as well and get matching confluences. So you can see how the -1 here overlaps with the -2 to -2.5, and the -2 to -2.5 here overlaps with the -4 standard deviations. So let's go ahead and continue these out and see what happens. So you can see we hit this low-hanging fruit and then get a little retracement. And here you can see we don't quite take those lows, but we do reach into the middle of this area. And now, if you've noticed, we are into our second example as we have a manipulation leg here. And so let's go ahead and project that out. And so now, if we are looking, what do we see? Well, we see we have a -2 to -2.5 here. Go ahead and mark that out. And then we have our -4 right there. Are there any PD arrays that line up in here? Well, we do have this order block here. If we mark out the mean threshold of that, it'll be right around the 2nd standard deviation. We went ahead and marked that out. And then we have all these equal highs resting above here with the 4th standard deviation. So let's go ahead and mark those out as well. So let's let this play out. And there we go, we reach into that 4th standard deviation. So let's clean up the chart a little bit here. So letting this continue to play out. And there you see we get to our 3rd example. So let's go ahead and mark out this manipulation leg once again and project it out. Let's see what happens here. You can see we hit our -1 standard deviation and currently getting a retracement. Let's see if we reach into the -2 to -2.5 or the 4th standard deviation. And do we have any PD arrays lining up with those? Well, looking left, we have a fair value gap right here. So we can go ahead and mark that out. And generally with a fair value gap like this, I'd be looking for the near side here as we have equal lows, but we can also mark out the consequent encroachment of this. And then the next thing, looking left, our 4th standard deviation lines up pretty closely with these lows right here. So those would be my 2 objectives for this market maker sell model. So here you can see we reach into the -2 to -2.5 standard deviations. We get a retracement here. And then finally we come down and hit our 4th standard deviation here below this low. So let's go ahead and zoom out here and see how this all worked out. And you can see we still have some projections down here. So let's skip ahead and see if price ever reaches those lows. And you can see here, price does sweep those lows. We still have this 4th standard deviation, which is aligned with our 2 to 2.5 right in this area. And there we go. And if you notice, we have another manipulation leg here that we can project out. And you can see we hit into our 2 to 2.5 standard deviations there. Now price is starting to trend up. Looking, where is our manipulation leg? Right here. So I can project this out. We have our 2 to 2.5 right here. And now we are in that 2 to 2.5 standard deviations. So sorry for the little bit of a mess here. Let me clean this up. So I hope in this example you saw that I can project manipulation legs out to give me targets. Using PD arrays, I can add to those targets. And then using multiple projections, I can add to the confluence. For example, when the -4 from one projection lines up with the -2 to -2.5 of another projection. So let's take a look at one example of this going top down and how you can use it on multiple different timeframes as well. So here we are on NQ daily chart. And if you can see, price reached up into this daily fair value gap on a Tuesday, made a reversal, and then the next day expanded lower and displaced below these lows. Anticipating a classic sell week with a Tuesday high, I'm anticipating Thursday to continue lower. So with that idea in mind, let's go ahead and drop down to the hourly chart. So here we are on the hourly chart, and this is the daily fair value gap here. Where is the manipulation on this time frame into that daily fair value gap? Well, here is the high into that fair value gap. Where is this swing or the low that made that high? Right here. So from here to here, that is our manipulation. So projecting that out from high to low, let's go ahead and zoom out here. So marking out Thursday, right here to right here, we could anticipate price reaching into the 2 to 2.5 standard deviations right here. And another thing you can do is mark out the consequent encroachment of these standard deviations. So if we're anticipating price to move lower into this area, let's drop down to a lower time frame and see what happens. So down here on the 15-minute chart, we'll go ahead and get into London session. We're going to go ahead and mark out our midnight open here, and let's see what happens. You can see Asia consolidation. London moves aggressively lower and then back into the range, accumulation, manipulation, so anticipating distribution. What do we have over here on the left side that is interesting? Well, we have equal highs resting here. So let's see what happens here. You can see we just sweep a low here, continue higher, and there we reach into those equal highs. Now, since London is retracing in terms of the weekly profile, I'm anticipating New York to move lower into this 2 to 2.5 standard deviation area. So let's drop down to a 5-minute chart. So as we near New York open, let's see what happens. And here on New York, you can see we get a big wick up and wick down. So let's drop down to a lower time frame to see what that looks like. So down here on the 2-minute, nothing really interesting towards the downside yet, but I am going to mark out this order block here and see if it forms. So here we get displacement below this order block and this wick here. So looking at this price action here, where is our manipulation? So you can see this is the leg that made the new high, and where is the low of that leg? Right there. So that is our manipulation. So projecting that out from our high to our low, There we have our projection. Now, the next thing we want to look for is, do we have any PD arrays lining up with those projections? So looking left, what do we have resting just above -2 standard deviation? We have our London low. So that would ideally be the target for this, as it is a low-hanging fruit. So let's zoom back in here and see if we can find an entry. Now, the first entry I would be looking for is a retest of this order block here, with my stop on this high, and then I'd be looking to target those London lows. So let's see if that tags me in. It does, and we start to get our distribution lower. And you can see we leave equal lows here, and we start to get a retracement. So marking out these other up close candles here, let's see if those provide a reaction. It does, and then we go in, we hit our London lows. So just to review what happened here, we have a classic sell week, so anticipating expansion into Thursday. We drop down to the hourly chart, we find the manipulation on the hourly chart and project it out, which gives us our overall target of this yellow box here, which let's see if that hits. And it does reach into there, and the consequent encroachment of that. Now, the next thing I did was drop down into the lower time frame, look at the daily profile, and then find an entry targeting those London lows. Now, I hope you found this video helpful. If you did, please like and subscribe. I am planning on my next video combining my previous video with this video, so an accumulation, manipulation, and distribution combined with standard deviations. If that is something that interests you, please let me know in the comments section below. And other than that, I'll see you guys next week. Have a great one. How's it going, everyone? This video is going to be over standard deviation projections and combining that with accumulation, manipulation, and distribution. Now, if you haven't seen my videos on the topics, I'll go ahead and link those in the description below, and I'd recommend watching those prior to this video. But other than that, let's hop into the PDF before some examples. So a brief review of what accumulation, manipulation, and distribution is accumulation is essentially some sort of consolidation, manipulation is a fake breakout or the false move, and then distribution is the real move in the opposite direction of the manipulation. So looking at a candlestick chart, we have some sort of consolidation or accumulation, manipulation, which is the move or the fake breakout, and then we have our distribution. So zooming in on these candles here, you can see we have accumulation, manipulation, and then distribution. And with projecting this out, we want to focus on the manipulation. Now, where is the manipulation we're focusing on? We want to see the leg that made the low before the high. So essentially the breaker formation as well. So from here, we'll take the high to the low and project it out, and those will give us targets for the distribution. So putting it all together, we have accumulation, manipulation, and distribution, and we project this manipulation leg, giving us targets for this distribution. So here we are with our first example. We'll walk through the price action, projecting out the manipulation, as well as a few possible entries. So you can see here we create equal highs. So let's see what happens next. You can see we start to get this consolidation here. So I'll go ahead and mark that out here. So we get an aggressive move over this buy side liquidity pool. Now, if we want this to be a manipulation, what do we want to see next? We want to see displacement back into the range and breaking structure or changing the state of delivery. Or if you've seen my box setup, aggressive out and aggressive back into the range. So let's see what happens next. And there we get aggressive displacement down. If we weren't to get this aggressive displacement down, then it's likely to continue higher. So let's go ahead and mark out our manipulation. So here is our manipulation, and if we mark out our change in state of delivery, it would be right there, and our market structure shift would be right here. So now that I have this marked out, how can I combine this with standard deviations? Well, I'm looking to project out the manipulation leg. So I look at the manipulation, where is the low that made this high? Right here. So I'll go ahead and project from this high to this low, and now I have projection targets. So zooming out a little, the first thing I want to look for is the -2 to 2.5 standard deviations, and then the fourth standard deviation. So how would I look to take an entry here? Well, I could enter on the change of the state of delivery or this order block, or look for the fair value gap. Considering they are in the same spot, I'll look to take my entry there, my stop on this high, then my first target will be the -2 standard deviations. So there we get tagged in, and we reach lower to that -2 standard deviations. Now, if we're going to continue lower to the fourth standard deviation, I'd like to see price respect these up close candles here, which is an order block. So let's see what happens there. So price is respecting it. We get an extra little sweep there, but you notice how the bodies don't reach over this. Now let's see if we get a continuation lower to this fourth standard deviation. And there you can see we hit the fourth standard deviation. So just to quickly review, we have equal highs here. we have accumulation or consolidation just below these equal highs, an aggressive move out and back into the range, which shifts structure as well as changes the state of delivery. Then we retrace back into the order block as well as the fair value gap here, and then get this placement down to the 2 to 2.5 standard deviations, a retracement back into up close candles or an order block, before a continuation lower to the -4 standard deviation. I had many requests for this video to combine the box setup with AMD and the projections, so in this example, that is what we are going to be doing. So if you notice here, we are starting to consolidate. And here we just focus on aggressive move out and back into the range. So even if you don't see this as an aggressive move out, we get an aggressive move back in. Now we can go ahead and identify our consolidation. And for the box setup, I use the bodies. So you can see this is where I'd mark out the consolidation. Our manipulation would be anything over these bodies here. And then I'm anticipating distribution. Now before we get any further, I want to project out that manipulation leg. So going from the high, where is the low that made the high? So from right here, I can go to this low here. And the reason for that low is we have a green candle that went up, red candle down, then up again. So this is a swing low on a lower time frame. So now that we know this, using the box setup, what I do is grab the highest bodies, extend that over, and that is my entry. Using that as my entry, I want to put my stop on the manipulation high, and then look to target that second standard deviation. So let's go ahead and let this play out. So here we get some more consolidation. Aggressive move up, so that would be the entry there. You can see retesting those previous highs. And then we get our aggressive move down. And hitting our second standard deviation there. So cleaning it up a little, you can see we have accumulation, manipulation, and then we retest these previous highs or the previous high of the accumulation or consolidation before our distribution lower. So watching this play out a little more, we are in our -2 to -2.5, which is our retracement or reversal area. So here we do get aggressive down and then back up, but it never took anything, right? No sell side liquidity. There wasn't really any consolidation here. So let's let this continue. Here you can see we start to have some consolidation. We're building lows and highs. So marking out those lows and highs, that is a box. And here we get an aggressive displacement lower. And then we get displacement back into the range. So this is manipulation or a deviation from the range. So marking out our consolidation, we have it right here. And then ideally looking to take an entry at the retest of this deviation from the range right there. And then where can we get a target? Well, we have an aggressive move down here with an imbalance. So if we go ahead and project this manipulation leg out, we have this -1 right here that lines up perfectly with the start of this fair value gap. So we'll go ahead and target that. Now, one thing I look for, if I'm not confident in this entry, what I'll look for is a down close candle into this area that then gets closed over, validating it as an order block. And then I can look to take an entry right here, my stop on the order block low, and target the same area. So it looks something like this. But either way, you can see how that worked out. We reach into that fair value gap that lines up with the -1 standard deviation, but hopefully this shows you how the box setup can be paired with standard deviation projections as well. In our last example, we are going to take a look at the AMD between sessions. Generally, I like to see Asia accumulate, London manipulate, and then New York distribute. So we are getting near the London session here. What did Asia do? It accumulated or consolidated. So marking out this range here as our consolidation. Let's see what happens as we move into London. So here in London, you notice we get an aggressive move out of this range, sweeping this low. So if this is going to be manipulation and we want to see a move to the upside, we want to see aggressive displacement back into the range. If this is going to continue lower, we want to see a retracement before moving lower. Here we get aggressive displacement back into the range. So now what can we do? Well, we have a new low. Where is the high that made the low? Let's project that out. So from this low to this high, we have our projection. So looking at this, what can we see? We look left. Right before the -2 standard deviations, we have a failure swing, and then we have this high resting in here. So those are ideally the target for this move. So now that we have our London manipulation, let's go ahead and mark that out. And let's see what happens as we move into New York here. Here you can see we retest this breaker here. And then we get displacement up here. And now just prior to New York, what do we have? Well, we have a fair value gap here. So if I was going to be looking to take an entry, Could look for an entry in here, my stop on this low, and then ideally I would be targeting this failure swing here, as that would be the low hanging fruit. So let's see how this works out. And there you go, price delivers to the low hanging fruit as well as this old high over here. And just to review what happened, we have Asia accumulation, London manipulation, and then we expect distribution into the New York session, which delivers to these old highs, as well as hitting the -2 and -2.5 standard deviations off of the London manipulation. I hope you found this video insightful. If you did, please consider liking and subscribing, and I'll see you guys next week. Have a good one. How's it going, everyone? This video is going to be over inducement. First thing we're going to do is define inducement and what it looks like, and then we will go into some examples. Inducement is essentially a move that induces buyers or sellers into the market. So for example, right here, it looks as if we are gaining support and we are going to break over this high. So people who are breakout buyers will be buying right here. Similarly, anyone short in here will have their buy stops resting above here. So we have willing participants buying above these highs. This is where smart money sells short for the move lower. Another way to think about this is our accumulation, this is our manipulation, and this is our distribution. With bullish order flow, it looks as if we've hit resistance. And so when we break this low, breakout sellers enter the market, as well as people who are long in here get stopped out. This is where smart money buys for the move higher. So just like over on this side, we have our accumulation, our manipulation, and then our distribution. So simply put, with bearish order flow, I'm looking for highs to be ran to position short. And with bullish order flow, I'm looking for lows to be ran to position long. So looking at the second diagram, if the trend is down or order flow is bearish, I'm looking for short setups above previous highs. Once I hit the higher time frame PD array, I'm looking for the inducement that occurs at the smart money reversal. Order flow is bullish. I am then looking for long setups below lows. So for example, these deviations from the range are where I am hunting setups. The last thing that I will mention is I prefer these to occur within PD arrays. So we have an inducement into a PD array and then a move higher. And we will get into some examples for that. For our first example, we have S&P 5-minute chart up, and we are currently trending down. As we continue here, what we notice is a failure to close below this low. We have this high right here. If we break this high, we will shift structure upward. And there we go, we get our market structure shift. And from here, what do we have? We have an order block or fair value gap. Now let's see what happens. So you can see how price respected this fair value gap, the consequent encroachment of it, as well as this order block. Now, if we let this continue to play out, what happens? Before price continues up and takes this high, what it does is it engineers more buy-side liquidity right here. It then runs down and sweeps this low. This is the inducement right here, before then expanding upwards. So what would it look like if I was going to take this inducement setup? Well, let's go ahead and rewind it to here. And what I do is I position myself to enter this trade once we break this low with my stop where it normally would be, partial at this high. So if we let this play out again, you'll see how that works. Taking a quick look at the diagram I made for this price action here, you can see once order flow becomes bullish right here after the structure shift, I then look for a low to be ran before going higher. For the next example here, we have the 15-minute chart for the S&P 500. And what do we have? We have an aggressive move down, an aggressive move back up with overlapping fair value gaps. Now what happens when we play this ahead? So you can see a nice stop run right here. As we can't close back, we reach back into this fair value gap. What do we do now? We reach back up, we can't close over this high. And what do we have resting down here within a PD array? A low. Right there, we take this low, completely fill in this fair value gap. And where do we expect price to reach now? Our current buy side and this high. And then we get a nice expansion move higher. So if we look at this diagram right here, we had a low in a PD array, which was then taken prior to the actual move. My favorite setups are when price barely reaches into this PD array, as it did here, or if we have equilibrium of the range, price did not yet reach into an equilibrium or a discount, and it just puts a low right there. That is what I like to see.
Our next example is on NQ 5-minute chart. So if you look right here, we have a strong impulsive move up. However, I am expecting a retracement. We come up, cannot close over this high, and then get an aggressive move down. You can see it retests the old high and then continues lower. Now what I look for here is we have an old low right here. And where is that low sitting? Within a fair value gap. So watching these next candles, we can see we struggle to close lower. And from here, I'd want to see an expansion higher. And there we go. We go take this current high. For this next example, we are going to go out to the 4-hour chart. If you can see right here, we ran this previous low, closed back into the range, and then we got a displacement move higher. Now, if you notice here, we have a fair value gap and price putting in a low here. As we let this continue forward, we get a move below that low, no closes below it, and then a continuation higher. I think let's continue. There's a fair value gap. And then here is another low. And we are struggling to reach higher, so we're likely to draw lower towards this low. If you notice, struggling to reach lower, especially with the strong close right here. So I would then want to see price reach up towards buy-side liquidity. And there we go. So that is an example of 2 inducement moves in this price leg. The last thing I'm going to go over is how I use this in trending markets. This is very similar to my displacement versus lack of displacement video. So if you haven't seen that, I'll put that in the top right. But when we are trending up, I want to look for lows to be ran to gain entry. And so if you notice right here, we ran a low, here we ran a low, and then here we ran a low. So in just this section right here, there are 3 possible entries. If you notice how these closes respect these old lows, that is the key. I hope you enjoyed this video. If you did, please consider giving it a like and subscribing. And I hope you have a great rest of your day. See ya. How's it going, everyone? This video is going to be on open high low close and open low high close. First, I'm going to look at an open low high close, or what I'm expecting with a bullish candle. Now, why is that? Well, every candle has an open high, low, and close. Now, if we have a bullish candle forming, unless this candle is not going to have a low like this, and the low is going to be the same as the open, it's going to have to move below the open to put in a low before going higher. With knowing that, I can look for opportunities to buy below the open or near the open, expecting this expansion up until we put in a high and then close this candle. Now with the open high low close and expecting a bearish candle, I'm expecting a high to be put in above the open. Now this is where I want to look for selling opportunities between this high and around this opening price, expecting an expansion down before the low and the close. Now, how do I know if I'm expecting a bearish or bullish candle? This is dependent on my draw on liquidity or where I think price is likely to reach for. If you haven't seen my video on draw on liquidity, I will link it in the top right over here. So let's get into some examples here. We have ES daily chart, and we are looking at the formation of the weekly candle here. If we are expecting a bearish week, we would want to see a high put in, so an open high low close. And if we're expecting a bullish week, we'd want to see an open low high close. So here's Monday. As we go ahead to Tuesday, you can see we put in a nice little low. If we're going to move higher, then we'd want to see expansion up until we put in a high and then close. So there are the expansion candles, and you can see how our weekly candle formed here with our opening price, our low, our high, and then the close. For this next example, I am looking at NASDAQ on the 15-minute chart, and I am going to be using midnight opening price as the open for this daily candle. And so as we let it play out, now if you look right here, we have our open, we have a high, and if we're going to expand down, I'd want to see a low, then a close. And there we go. We have our open, high, low close of the daily candle. And as I said in the diagrams before, I want to be looking for selling opportunities above or around this midnight opening price. So here's an example where I have identified a draw on liquidity, and we are on the 4-hour chart. So what I'm looking for is after this down close candle, I'm looking for an open, low, high close of the next 4-hour candle. So with that idea in mind, we are going to drop down to the 5-minute chart. So here you can see the previous 4-hour candle. And when we open up the next candle, I'm going to be looking at a move to put in a low before an expansion, reaching for my draw on liquidity. So we have the open of this candle. Let's see what happens. We put in a low currently. We reach above. And now you can see how that opening price is supporting the candles. And nothing is closing below it. I'm expecting a move higher. And now we get an expansion, reaching for the identified draw on liquidity. And if we let this continue, we put in a high and then close the candle. So this is an example of how I identified a draw on liquidity. I look for an open, low, and then I can expect a move up towards my draw on liquidity before a high is put in, and then a close of that candle. Another way to think about this is in terms of accumulation, manipulation, and distribution. So if we look at it like this, we have our opening price, and you can see we consolidate around here. That is our accumulation. Now, if we look what happens when we go above this opening price, that is our manipulation right here. What happens after our manipulation, or we put a high in the open high, we get our sell-off to go put in the low and the close of this candle, as so. I hope you found this video helpful. If you did, please consider liking and subscribing, and I hope you have a great rest of your day. See ya. How's it going, everyone? This video is going to be over low resistance liquidity runs, the difference between low resistance and high resistance, and why I like to use low resistance liquidity as a target. The first thing we're going to cover, what is low resistance liquidity and how does it differ from high resistance liquidity? So if we're looking right here on the left side, you can see we have a high resting here, and then this price leg right here goes back up and does not sweep it before the reversal. So you can see right here, it has that high, does not get swept. Thus, there is more resting liquidity there. This is defined as low resistance liquidity. Now, if we look over here, we have this resting liquidity, and this price leg goes up and sweeps it. So there is now no resting liquidity there. However, there is liquidity at this high. This is the definition of high resistance liquidity. So in comparing the two, low resistance liquidity is just a high or low with a failure swing, while high resistance liquidity does not have a failure swing and price sweeps the liquidity before reversing. Before I get into any examples, how does knowing where the low resistance liquidity lies actually beneficial in my trading? Well, prior to the session that I'm trading, I will look for low resistance liquidity as a target because price is much more likely to expand through this area than if this high was already taken and we only had high resistance liquidity resting here. For this first example, we are going to look at NASDAQ on the 15-minute chart. The order flow is bearish, so looking for a continuation of that order flow, I want to see price reach back up into a premium of the range and into a bearish PD array, which we have a fair value gap right here. Now we also have these highs resting right here. If you notice, they are failure swings, so that is low resistance liquidity. So I'd like to see those be taken out. So as we play it ahead, you can see price went up, took out this high, closing back into the range. I would want to see sell side liquidity taken now. So looking at this range, what do we see? Well, I see all these stacked lows down here. But most importantly, this low resistance liquidity resting right in here. So I'd want to see price reach through this low and possibly go for this low down here. So there we go. Price reaches through that low and then goes and takes out this low as well. Now, as we near the New York session, price starts to get a little bit of a retracement. And if you notice what is happening right here is price put in a low and then could not take that low out. So this is our low resistance liquidity or failure swing. So price reaching back up into the range. And there we go. We see a drop. and we have a 15-minute fair value gap right here. So this is when I would expect price to go for the fair value gap and then reach for the low resistance liquidity below, and ultimately to our draw on liquidity below. And there we go. We get our move down. Now you can see with both of these moves here, I had low resistance liquidity resting below as a target, and I expected price to continue the bearish order flow on the higher time frame and reach below these lows. For this next example, we're going to be looking at GBP USD on the daily chart. And another thing I will look for are consecutive candles where no high is broken. And I will mark that out and then explain it. So what this really is no previous day high was ever taken out for multiple consecutive days. And what does that mean? It means on a lower time frame, there are a bunch of failure swings, or this whole area is low resistance liquidity. So dropping down to a 4-hour chart, you can see all these highs marked out as previous day highs, and no high ever came up and took it. What does that leave us with? Low resistance liquidity, and we expect price, if it starts to break through these highs, to continue through them and expand in that direction. So letting this play out, we'll go back to the daily chart. You can see we expand through all those highs, and then as we get a failure to close out of the range, we take a previous day high and fall back in, and order flow becomes bearish, and that is where we're at today. We are going to go over high resistance liquidity and low resistance liquidity. So if you notice right here, we have sell side right here. And as we continue forward, price takes it out, closes back into the range, and this next candle opens up and closes back into the range as well. What does this now create? Well, it's not a failure swing, so this becomes high resistance liquidity. So if I'm going to be targeting it in the future, this is generally when I want to look for the failure swing above it, or using the CE of the wick. After price closed back into this range, where do my eyes go? Well, these highs, right? And what do we notice about these highs? These are all failure swings, or what does that create? Low resistance liquidity. So I would expect price to expand through this range right here. And there we go. We get an expansion through that range. Now let's take a look when price returns to this high resistance liquidity and why I don't really like targeting the lows of high resistance liquidity. So if you notice, when price came back here, this is when I use the CE of the wick, or this failure swing right after the low. And the reason for that being is this is going to be a lot harder to break through than this low resistance liquidity right here. For this last example, we are going to look at NASDAQ on the 5-minute and 1-minute charts. So looking at this original consolidation down here, what do we have? Well, we have a move that took a low before going up. And what does this create? This creates our high resistance liquidity. So as I said in the last example, I generally look for a failure swing after this to target. Now that we have that, we also have an equal low right here. But looking at the 5-minute chart, what do we have right here? Well, we have consolidation. Now with this move up and back into the range, this is our manipulation. So I would like to see expansion to our target and ideally below this old low. Let's go to the 1-minute so you can see what these lows look like and why I would be comfortable taking this trade even if we didn't have this low over here. So dropping to the 1-minute, if you look right here, here, and here, these are all failure swings, and what does that create? Low resistance liquidity. So I would ideally like to see price expand through these lows right into here, and ideally reach for this old low over here, but I would be more confident in it just reaching for this low. So as we let this play out, you can see we expand down, we hit that failure swing and the equal lows right there, and then we consolidate for a while before finally going down and taking this old low. So you can see why I would rather save myself the time and just exit my position at this failure swing and equal low than holding to reach for that high resistance liquidity. I hope you enjoyed this video. If you did, please consider giving it a like and subscribing, and I hope you have a great rest of your day. See ya. How's it going, everyone? This video is going to be over the seek and destroy pattern, when I expect this pattern to occur, and how I search for entries within it. So what is a seek and destroy profile? A seek and destroy profile is a lack of higher time frame direction relative to the time frame you're watching, which leaves us with consolidation. So looking at this diagram here, you can see we have our sell side and buy side liquidity created from this price leg up. Now with a consolidation on the higher time frame, I'm expecting when price tries to leave this range to return back into the range. So you can see at these highs, after it sweeps buy side liquidity, it comes back into the range. And at the lows, when it sweeps sell side liquidity, it comes back into the range. This concept is fractal, so with this larger time frame seek and destroy profile, we can also have lower time frame seek and destroy profiles within that, as you can see here. So generally I like to stay away from this profile as it's pretty choppy. However, if I choose to trade it, there are a few things that I look for. The first thing I do is identify deviations from the range. So if we look on this chart here, where do we deviate from the range or take buy side or sell side liquidity? So now that I have my deviations marked out, these are the areas that I will be looking for a trade, and where am I generally targeting with these trades? So in terms of targets, there are 3 things that I look for. That is 1, equilibrium, 2, OTE, and then 3, the other side of the range, buy side or sell side liquidity. So let's go over those real quick. So looking at this diagram, we can see we have a deviation from the range right here, expecting a price to reach back into the range. What do we want to look for? The first one would be equilibrium. So looking at the equilibrium of the range, my first target would be right around here. Now for the second option, I will look for an OTE, and for that, I will use a fib. So my next target would be right in here. And then finally, we now have buy side liquidity right here, and that would be my third target. So looking at the rest of the examples in the diagram, you can see for this first deviation from the range, I'd be looking for the equilibrium right here, OTE, and then the sell stops resting below. This deviation from the range, I now look for an equilibrium of this price leg down, an OTE, and then the buy stops resting above here. For this one, I'd be looking for an equilibrium of this range, OTE, and then the sell stops resting below here. So what do I look for on a daily basis that may give me an indication that a seek and destroy pattern may occur throughout the day? I look for London session to take the high and the low of the Asian range. And what this does is it creates a deviation on both sides of the range. And what I can expect for the New York AM session is either consolidation or for London session low and high to be targeted. For this first example, I have the Asian range high and low marked out, and we are going to watch the price action as we go towards London and just after London. So as we go ahead here, you can see we leave Asia session low. Now we take Asian high, but do we come back into the range? We do. So this is our deviation from the range, our first one. Now we want to see, do we take our Asian session low? And we do. So we have 2 deviations from the range here. And what do we have with those deviations? We now have buy side and sell side liquidity. So as we come towards the New York session open, we would want to be watching these areas. Right there, we sweep sell side liquidity, we get a move back into the range, and if we do, where are we likely to be headed? For these high. So right there, we get a large displacement candle. We have an order block. So I'd be looking for a reaction here to look for that buy side liquidity. And we now have another deviation right here. So as we play this forward, you can see we go ahead and we take the other side of the range. So now we have another deviation from the range. However, with a super large displacement candle here, we may start to leave this range. And you can see how we start to go a little bit higher there. And one little tip is, if you understand the strat or have seen my broadening formation video, if we take these lows that were purged and we run them down, and these highs, what do we have right here? We have a broadening formation. In this next example, we will look at Asia session high and low, but we'll also look at just using it within a range. So if you look right here, we have sell side and buy side liquidity from this large range, which we are currently consolidating in. So our main focus will be looking at this high and this low, but also noticing how price reacts to the Asia high and low. So you can see we took the Asia high, come back into the range, but just consolidate, retest midnight open, and there we go and take our buy side liquidity. So this is our deviation from our current range. So looking at it, where would we want price to reach for? Well, we could see price reach for either equilibrium of this range, OTE of this range, or sell side liquidity. As price goes down, you can see we put in another low right next to our Asia low, which is just engineering sell-side liquidity. We then take that low right into our OTE, and we get a reaction out of that back into a fair value gap. Go ahead and delete these so it doesn't clutter. And now as we near our New York Open, as stated in the previous diagram, we'll either get consolidation or a reach for either side of the range. If you notice here, this pattern or profile is being fractal, we can see how each time we take sell side or buy side, we are just coming back into the range. So as we let this play out further, you can see we take our sell side again, come back into the range. We finally go reach for this low, and if you notice, we put in quite a few highs up here, so I'd either want to see it reach back into an equilibrium, OTE, or ideally back into these highs. So looking at our deviation here, letting this play out, there's a move back to this high. Where do we go? Back to an equilibrium, or in this case, an OTE. Now where do we go from here? Well, we have more buy-side liquidity. And this will be a great example of how you can use it for routing information. And price, when in a seek and destroy profile, will respect that fairly well. Cleaning this up and going to let it play out, what are the three things we're looking for from this deviation down here? Well, that is either a reach for an OTE from this high to this low in equilibrium, or reaching for this buy-side liquidity. And so if you notice, we already hit our equilibrium right here. We've reached out into an OTE, and if we are going to expand, I'd want to see us reach up into there. And there we go. We reach for buy-side liquidity. And if we fast forward ahead, when this price leg went up and took these highs, we put in a high. Where do we retrace to? Equilibrium before getting a move back up, reaching for OTE, getting another little retracement before finally going and taking out our sell-side liquidity. I hope you found this video helpful and insightful, and if you did, please consider liking and subscribing, and I hope you have a great rest of your day. See ya. How's it going, everyone? This video is going to be over how I trade without market structure shifts or market structure breaks. A lot of times when I was waiting for a market structure shift or break, I would miss the move and then feel some FOMO, so I figured out how to enter prior to that. There are two things that I look for when trading without a market structure shift or break, and the first one is a higher time frame point of interest. This can be highs and lows, fair value gaps, order blocks, whatever PD array that you select for your point of interest. The next and most important is a run of a short-term high or low, and aggressive move back up or down. So as just stated, I look for a higher time frame point of interest or a liquidity rate or both. So for example, in terms of a liquidity rate, I look for a short-term low or high to be ran aggressively and then return back into the range, usually resulting in either a BPR or fair value gap entry right here, or a box setup. If you haven't seen those videos, I will link them above. And then the other thing I will look for is a higher time frame point of interest, which is then ran aggressively, so aggressively down and then back up. This allows no closure on a higher time frame below that level, and then an OTE entry or discount or premium entry there. So if you get both of these, it would look something like this, where you have a higher time frame point of interest, which we have reached into, a short-term low being ran, which results in a BPR or box setup entry, and similar thing right here. So for example, we have this higher time frame point of interest, which if we go out to a 15-minute chart, you can see is just a previous low. Now if we go to a 5-minute chart, we can skip ahead, and you can see we never took that low. No reason to be looking long yet. Now we get a move below this low. So I go down to the 1-minute chart, and then I look for something like this. I want to see an aggressive move below a low, and then an aggressive move back into this range. This will give you a BPR or a box setup. So for example, if you're looking for a BPR, will be right there, or the box setup would be these lows right here. Then I would look for an entry along one of these areas. So for example, the box entry would be like that, or BPR entry would look something like that. And then entered into the position, my first take profit, could be there or these highs, but ideally I'd want to be targeting these internal highs right here. 2.6R, and that would be the trade. Now looking at this, I want to emphasize the most important part of searching for these entries is the aggressive move out of a range, right? So this low, and an aggressive move back into this range. Some of you may have already noticed, but this aggressive move out and aggressive move back into a range will create the wick of a hammer candle on the higher time frame, as shown there on a 5-minute chart. And if this was on the high of the range, you have an aggressive move up and then down, that will create a shooter candle. So for our next example, we have a OTE area on the hourly chart after this displacement move up. And then if we go down to the 15-minute time frame, we have this previous low that gets ran. Going down to the 15-second time frame, you can see we run this low aggressively and aggressively come back into the range. If you are looking for an OTE area here, what PD array aligns up with it, / down close candle, and that would be the entry to get long with the stop on that low. And then my first target would be these previous lows. So if you can see, get reach up, and there's the previous lows, and we would be out of our trade for just over 4R. The important thing on this trade was that we took that previous low, and on a higher time frame, going back out to 5-minute, we failed to close or displace below this low, meaning that we might come back into the range, and ideally would want to see an OTE of this side of the range. So if we go back down to something like a 1-minute, we would want to see price reach up into this OTE area, and so we will see if it does. And there it goes, takes this internal high and falls back into the range. Depending on the time frame I'm trading, for example, this is the hourly chart, I can use it as bias as well. So if I don't want to enter on the 1-hour chart, I can use the model on this time frame to look to the lower time frame. So for example, here we have this low right here that gets ran, and then we want to see if we get an aggressive move back up, which we do right here. So with that idea in mind, we have our fair value gap, or BPR, right here. And we have this previous low right here as well, or if you wanted to use the bodies. I could enter on the hourly right here with a stop on this low, targeting this high, and would be just fine with that. However, if I wanted to reduce my risk, I can go down to something like a 5-minute. So we want to wait for RTH open, or after 9, let's say, and go down to the 5-minute. So when we get down here, right here, go down to the 5-minute. So if you notice, we are in this area. We have an aggressive move down, an aggressive move back up, and whenever that move tops out, right, which looks to be right there, mark out our OTE of this range, just using the 0.62 as an entry, which right here, stop on this low, and then I would target the same area up here as the hourly target. So letting that work out on the 5-minute, or in on the 5, and then going back out to something like a 15-minute time frame, we will see how that works. And if it hits the target, which it does right there. It doesn't have to be used as an entry model. It can also be used in terms of bias, but mostly focusing on the displacement after running lows or highs. I hope you found this video helpful. If you do, please consider liking and subscribing. It does help me out a lot. And I hope you guys have a great 2023. See ya. How's it going, everyone? This video is going to be about entries, specifically taking daily bias and then dropping to the lower time frames to gain entry. Since releasing the daily bias video, this has been the topic I've gotten the most questions on, so it felt fitting to make this my next video. Now, I've already made a video on building an entry model. If you haven't seen that, I'll link it in the top right. However, if you have seen it and would like me to remake it, please let me know in the comments below, and I'll be sure to get to that. The thing we're going to do is hop over to Twitter and go to the MMXM Trader's Twitter page. If you don't know who he is who taught me a lot of what I know, so we'll go to his page for an example before we go back to TradingView and find some of our own. So if we scroll down his page here, here's the example we're going to focus on. So if we go ahead and zoom in here, we'll go ahead and look at the daily chart. So here we are on the daily chart. Let's take a look and see how he framed this trade. So we'd go in, put in a swing low here, return to the fair value gap, fill the fair value gap here, and then he anticipates a move towards this sell side liquidity and this low resting below. So with that idea in mind, looking for short setups in here. Where does he go from here? He drops down to the hourly chart. So here you can see we reach into this point of interest or fill the daily fair value gap, and then we shift structure bearish. From here, we get a retracement back up, reach into a breaker block plus the fair value gap before it trades lower to that sell side liquidity. So let's go look in here and see what he uses to frame an entry. So here we are on the 5-minute chart. Here you can see the hourly breaker and fair value gap. We reach up into that, displace lower, put in a lower high, lower low. We start to trend lower, and then he takes an entry here on this 5-minute fair value gap fill, targeting lower prices. So what can we learn from studying this example? We know we started with the daily chart, and then from there went to a lower time frame to get a point of interest, and then from there went to another lower time frame to get an entry. So let's hop back into TradingView and go over a few more examples on the charts. So in this example, we are watching NASDAQ on the daily chart, and it is going to be focused on the 24th of August. Now, if you notice, we already took a swing low, reached our 2.5 standard deviations, and we get an aggressive move up on Monday that continues into Wednesday. Now here I'm noticing we fail to displace over this swing high, so that leads me to believe that there may be downside. Now the next thing I'm going to mark out is previous day high and low, and I will also mark out this daily order block here. As if we reach up higher, I would expect this to resist price. From here, I'm going to drop down to the hourly chart to see if I have a point of interest that aligns with my bias, which is bearish. So here we are on the hourly chart, and we'll go ahead and move it forward to see what happens. So as we reach into midnight, we're going to go ahead and mark out our midnight open. And let's see what happens during London. What I notice here is London sweeps these highs, but can't displace above them, and we start to move lower. Let's see what happens as we come closer to New York. So as we come into New York here, we get a move above the daily open, we close back in, and then we get displacement lower, making and validating this order block. So marking out this order block, this is my point of interest going into the New York open. Let's go down to the 5-minute chart. So here we are on the 5-minute chart. This is our hourly order block, and this is our previous day high. You can see we already reach above our daily open and displace back lower. So I'm interested in price once it reaches up into this area. Letting this move forward, you can see we use a fair value gap here to reach up into this hourly order block. Now I want to see if there's a reaction off of this PD array to give an opportunity or present an entry. So we get displacement down. What I see here is a high, low, higher high, lower low. So I'm going to mark out this candle here as a breaker block. Then I can anticipate this area resisting price, and I would not want to see price